conduct this meeting this morning because we had a long day in appropriations yesterday, but since he's not here, we'll get started because we're past time. So we welcome everybody in the room, and we always get such a big crowd when we have CapFin. Yeah. It's not, it's not, it's a lot more exciting than the Fireman A discussion we had yesterday that had the room packed. But anyway, we're delighted to have and welcome everybody, whether they're here or online. Do we have anybody appearing online? Who's Polly, do we have anybody or? Oh, it's Karen. Do we have anybody online today?
Mr. Chairman, Senator Guru is online.
Well, good morning, Senator Guru. We're glad to have you here. We're glad you could zoom in.
Good morning.
We understand why you might not want to drive all the way from Jackson. Oh, it's Guru. I thought you said Greer. And so anyway. So
okay, you can take it all back.
Make sure that, can you lock that screen on so we can watch Senator Guru all day? Because we want to, I'm concerned about him from yesterday. I think he was taking some time off from the committee meeting and no, anyway, glad to see you. Good to see you, Senator Guru.
Mr. Chairman.
Yes, Senator.
Defense,
are you going to stick up for your roommate?
In defense of the other half of the Barn Caucus, I would like to suggest that Senator Guru was an active participant all day yesterday.
I know he was because he was texting me remarks during the day, during the meeting. So anyway, good to see you, Senator Guru. And so why don't we go ahead and we'll call the roll and then we'll hand this over to the vice chairman to give my voice some rest today.
Absolutely. For Select Committee on Capital Financing and Investments on September 10th, 2021, Representative Schwartz. Here. Representative Obermueller. Here. Representative Larson. Here. Representative Harshman.
Excused, I guess. He's probably got a game today, so it's football season.
Representative Hallinan. Here. Senator Nethercott. Here. Here. Thank you. Senator Kinski. Here. Senator Hicks. Here. Senator Guru.
Here.
Senator Driscoll.
Here.
And thank you.
I'm sorry, Vice Chairman Nicholas.
I'm here.
Chairman Perkins.
I'm here too.
Awesome.
And can somebody text Senator or Representative Harshman and also just remind everyone, if you want to place your bets on the NC game tonight on DraftKings, since you can do that legally now, pick the high or low or see if NC covers the spread. Anyway, with that, Mr. Chairman, Mr. Vice Chairman, go ahead.
Okay, good morning. The agenda after roll call is approval of the May summary of proceedings. Moved and second to adopt. All those in favor say aye.
Aye.
Those opposed, that motion carries. Okay, we're moving expeditiously. We're already ahead of schedule. Update of operating matters and in-kind transactions. Treasurer Meyer, Don, and Patrick. Front and center.
We've got Katie in there too.
Perfect.
Mr. Chairman, I want to
Welcome, everybody.
yeah.
Good to see your smiling faces. Sorry I missed Saratoga.
Yeah, it's good to see all the committee members and the staff members. I see the staff has been working diligently on 121. Got a lot of information there. Look forward to that discussion. I'll just generally make some general remarks, Mr. Chairman, that the Treasurer's Office is, I guess, moving forward in the manner which we expect. Things are progressing well. We've got our deputy here that's going to start out, give you an overview. Patrick's going to work on some of the performances, and Katie is going to address some issues in the county. Not necessarily issues, but
Can everybody hear the treasurer? Can you move a little closer to the mic? I think that.
so anyway, Mr. Chairman, we've just in recapture, we've got our experts here. They're gonna roll with the ball, and so I turn it over to Don.
Okay, fire away.
Good morning, Mr. Chairman and committee. My name is, good morning, Dawn Williams, and I'm the Deputy State Treasurer. I'm pleased to offer you an update of what's going on in our office. And I want to begin by thanking those of you who were able to attend the Treasurers Conference in Saratoga as well as online. We really appreciate your support and we hope you enjoyed the content. As we've previously reported to you, our office is pursuing implementation of an upgraded accounting system. We've been working with 2 vendors over the last several months, and our accounting team has invested hundreds of hours to ensure that each of these vendors has been properly educated about our needs by conducting extensive trainings of our business processes. Concerns with the first vendor's ability to come up with the results led us need to ramp up efforts with our second vendor for a system upgrade. We'll have the results of that effort later this month and plan to make a commitment to one vendor or the other by October 1st. Then we'll begin the arduous but essential journey to implementation. And our goal is to implement the new accounting system in conjunction with the new fiscal year, July 1st of 2022. We are excited about the prospect and continue to pursue automation wherever we can. In the meantime, we've identified some things through these business process reviews with Jeanette Beeman, who is our infrastructure technology person. She's been able to come up with some automation as we've learned, and as well as with our current vendor, they've been able to identify some things that we can implement now that we were unaware of. So it's been a great exercise to go through all of these meetings. So speaking of automation, earlier this summer, we put out an RFP for an order management system for the investment team. This system electronically facilitates and manages our trade orders. Right now, everything's done manually. They send an email, they say, this is the trade we're going to execute. Our guys in the accounting team do the reconciliation, and order management system is going to automate all of that. The contract was awarded to Bloomberg and staff is working through the scoping document, and we'll have that implemented in the next coming month. So moving on to staffing, we currently have 5 vacancies in the office, 3 accounting positions and 2 investment positions. Yesterday, we conducted interviews for one of our accounting positions, and I'm pleased to say we were able to make an offer. That's super exciting because we've struggled to get applicants and then qualified applicants. So we got one handled yesterday, and we're going to conduct interviews for another position next week. So we're excited about that. That's for the accounting side. The 2 investment positions, we've decided to put on hold our recruitment efforts for now. As it's nearing the end of the year, these investment professionals will be nearing their performance bonuses and are unlikely to be looking to jump ship prior to achieving their bonus. So we're going to wait till later in the year, probably late October, to put those positions back out, and we'll heavily recruit again. We also have 2 investment intern positions. We got those AWACs for summer. And on September 20th, I think that's the Monday, there is a UW meet and greet for students. So we're going to get those intern positions posted in advance of that meet and greet over at the university, and try to recruit a couple of students to come and work for us next summer.
Please.
Yes, Mr. Chairman. Senator Hicks, thank you. So the 2 positions that are vacant are the senior investment officer and the investment officer. We had those positions were effective January 1st, and as soon as they were effective, we did advertise them. We've had a lot of interest, but nobody with the right experience. We want a fixed income specialist, someone who's actually managed a fixed income fund and not, or actively managed, not Patrick. There's a differentiation, as I've learned. You can't just sit back and tell managers what to do. We want someone who's actually actively managed the fund. And so we get a lot of people who apply that are equity specialists or they're hedge fund specialists, and those are just not the position we're looking for. So we did active recruiting through, Indeed and ZipRecruiter, and then we reached out to journals investment journals. And we just really haven't received any good applicants. So we're going to pull them back until mid to late October. I think I put the reminder on my calendar for October 18th. And we'll go ahead and we'll start that again. We'll spend money to advertise it in investment periodicals and online, of course, and through any professional organizations, the CFA Institute, all of the things that we can try to do. Mr. Chairman. Mr. Chairman, Senator Hicks. Mhm. Mr. Chairman and Senator Hicks, so same time frame. What we're sort of, that investment officer is also supposed to be a subordinate to that senior investment officer for fixed income. So we want to get the senior investment officer filled first so that we know what kind of person we're looking for to augment and support via the investment officer position. We also have, we've talked about internally growing and promoting folks. So the investment officer position, we haven't talked about when we'd like to get the senior investment officer filled first before we do that.
Go ahead.
Okay, thank you, Mr. Chairman. So the last thing I wanted to talk to you about is our budget submission to the governor. We don't really have any large requests. You've adequately funded us to be able to implement our accounting systems, our order management system, the OMS. But what we do need and what we have found is that we need another position in our accounting unit, despite having these vacancies. We need the vacancies that we have in accounting are the ones that the legislature gave us for the investment team to support our investment guy. All of them support the investment team, but we need another one to support the distributions of our investments, bonds, spending policy. We had a person that was doing this who recently left us to go to another job because she said it's just too much. Our folks do not work 40 hours a week. They're consistently 50 to 60. There's no work-life balance. That's the feedback we're getting. And so and I'm afraid, frankly, that that's going to start to affect folks in our other positions. There's a lot of pressure and there's just not that work. So we work very hard to find the right person and excellent candidates to work for us. And so when somebody leaves, it's a huge drop, difficulty. Since the rest of the team, so that concludes my comments, Mr. Chairman. I believe you had some questions about, we saw that you added in-kind transactions to the agenda. We're not exactly sure what you'd like to know, but we're willing to take your questions and give you some answers.
So I think the question on in-kind investments is how it affects the bookkeeping processes, how you deal with capital gains or losses between, if you're trading stocks between funds, how you follow the, how you do the bookkeeping on it and monitor a gain or a loss, or what the purchase price is for one versus the other comparable trades, and then how you do that over time when you sell them, and what's the practice in the industry. Just needing to learn more about it to understand it.
Thank you, Mr. Chairman. Katie, I'd like to cede to Katie. She is our Administrator of Financial Accounting, and she will do a much better job than I will to explain.
Mr. Chairman, if you don't mind, I've got this broken down in some series of questions that are right along there.
I think you should take over.
We'll just break that down. If we can, I'll just break that down a little bit. So the first question is have you guys got, I think the first question is can you help us understand the benefits of in-kind trading and the potential cost avoidance? Because I think most of this, as I understand it, is in large part a cost avoidance issue because we don't have to pay outside investment fees and things like that. So I think the first thing would help us understand the cost for avoiding from your perspective, the benefits and the costs and things like that. And it looks like you phoned a friend. And so anyway,
And maybe it's just some background first on what it is and what.
yeah. So we'll give us a little background and kind of practice and from your perspective, the benefits and the costs and the cost avoidance.
Mr. Chairman, members of the committee, my name is Patrick Fleming. I'm the Chief Investment Officer in the Treasurer's Office.
Patrick, you have a voice.
Much better. Thank you. I'm back.
Oh, it's Patrick. Okay. Patrick was in a bad way appearing by Zoom a week ago. So I was glad to see you back in the pink.
Well, yeah, you know what it's like. It's, yeah. But anyway, in-kind transfers. What we're talking about is when you're moving the securities from one internal fund to another. So there's two different ways to do it. We could do a buy and a sell when one fund is transferring up. There's a litany of reasons why, and Katie can go into that, or I can, if you want to get into details.
Well, at least give us the high points, and then we may drill down on some of them.
Perfect.
So go ahead.
So what happens is through quarterly rebalancing, demand needs from an income fund, a liquidation of a fund, what have you, there are times when you will transfer these securities from one entity to another. So the two different ways that you could do that is you could do a buy and sell. You could come in and tell the manager, liquidate 100 million of this. You take the money, you give it to the other manager, and you say, buy those exact same securities for $100 million. Now, depending on the security that we're referring to, for instance, if it was bank loans have a bid offer spread of usually between 1% to 2%. So just by doing that alone, in normal trading times, when things are volatile, that moves to 5 to 10%. So just say normal trading times, that 100 million, we would lose $2 million just by doing that transfer. It just makes no economic sense whatsoever. So the alternative way is to say, all of these securities are very liquid and mark to market. So every single day they have a price and they're marked. So another way you do it and say, you look at it and say, okay, the daily mark is X. And we're going to transfer those securities from this fund, from fund A to fund B at that closing valuation. So instead of having 100 million at this time and transferring, selling them and buying, and now you only have 98 million, instead you take 100 million, the other fund takes ownership of them, transfers the cash, $100 million. So that is a widely done. This is not anything that's crazy. Every single dealer fund that we're aware of doing kind transfers. They
Oh, yes, you are. I think you are.
Mr. Chairman, Senator, no, that is not the case. If there's no such thing of transferring within the fund because they only own it. So PMTF owns the 100 million of those bank loans.
So let's go back. Maybe so it goes back because I mean at the end of the quarter, at the end of the fiscal year, you did quite a few of these, and so help us give us a for instance, Pat. Just give us a for instance of about one of the in-kind trades you made at the end of the year because of some of the rebalancing you were doing.
Okay, let's just take an example. Fund A has 50% equities and 50% bonds. Fund B has 100% equities, let's just say for argument's sake, $100 each instead of percentage wise. Equities are up 10%. So the asset allocation for Fund A is 50-50 and for Fund B is 100%. Equities rally by 10%. At the end of the year, Fund A has 55 million in equities, and let's just say fixed income's flat. They have 50. Fund B is now $110. Okay, our asset allocation is 100%. Let's just assume those were all realized, and so that has to be distributed. And then all of a sudden we look at it and we say, we're going to move the asset allocation in Fund A to a 60-40. So now Fund A should have 60% in equities and 40% in bonds. Well, they have $55, we know now, and they have 50 in bonds. They would sell $10 worth of bonds to get them to 40. Now Fund A needs to get another 5 million in equities to reach their 60-40. Am I clear so far? Okay, now Fund B, they just had a 10% return in equities. That fund is at 110 million. Okay, so now by statute or whatever, you have to, be at the 100%. So they need to sell $10 in equities. Well, if we sold the 10 and then turned around and bought that additional 5, we would go through those transaction costs, which I referred to. So instead, Fund A, they were at 55, right? They have to be at 60. We would then transfer 5 million of that to Fund A. Fund B then would liquidate, sell, which we do every quarter, to get it back down to its asset allocation. So every quarter, we go back to whatever our allocation would be. So that would be an instance where at the end of every quarter, we do quarterly rebalancing. And we look at it, and it's a normal course of business, and it allows us, if you go back, we can statistically show you by doing rebalancing, that is a benefit to the fund.
So in going back to your example, so when we do that, we've locked in one fund, we've got to purchase. In another fund, we've got to realize capital. We've got a realized or unrealized capital gain or loss in the fund that sold the securities.
Mr. Chairman, that is absolutely correct. So
Which
that
do
is
we
where
have?
that
Is it
realized.
realized or unrealized now?
Well, okay, so in that instance, Fund B had to sell the $10 worth, right? We're at 110, they had to sell the 10 to come back. Fund A, they used the cash from selling those treasuries to be able to buy the equities. So at that closing value, June 30, let's say, or whenever we don't do it on June 30, we're offset by a month. At that day, we know the valuation of all these securities. And so they would come in and do those transactions. Now, that $10 from Fund B, it all depends, and we never know of that 10, how much is actually going to be a realized gain or not. Now, let's just take this last year, for example. Equities were basically in 15 months, we're up over 100%. So there is going to be a much larger realized capital gains in a year like that than we normally would have, which is approximately 7% return over the last 20 years, if you will. So then in a normal year, you'd only have a 7% return and you wouldn't have that many. But in this year, because we had 100%, there's going to be a much larger realized capital gain than a normal year. So in that instance,
Go ahead.
in that instance, now you have the realized gain portion that then will have to be realized at a later date. And that's where Katie can get into the actual how we account for that realized gain.
Okay, and so that, I think that's really important because, I mean, if in the example you gave, you went to cash, so that's an easy one. Then it really is realized. But if we're trading the securities for bonds, or trading one security for another security, then there's not a realization of the gain. And so maybe that's where Katie comes in.
So, Mr. Chairman, let me just clarify on that. Of that $10 that we just talked about that we had to liquidate in Fund B, 5 is the in-kind transfer. The other 5 is liquidated and we would realize those gains at that time or whatever, because that is an actual transaction of liquidating the security. So the in-kind transfer part is what Katie is going to reference. I just want to make sure everyone's clear.
So let's come back to that thought. So before we move to Katie and the back and the mid office and back office part of this transaction. So what I believe I heard you say was that when we do this, we liquidate enough to lock in the capital gain, so that the gain is realized, and then the basis, the value of equivalent equal to the basis is transferred over. Is that what I heard you say?
So there's 2 points here, and then I'll pass over the difference. The one is whether or not we're actually liquidating. So in this example,
Right.
there would
If
be
we
2.
liquidate, I don't think there's a problem.
So the fixed income, we went from $50 to 40. whatever that $10 liquidation was, would then incur either an actual realization of a realized capital gain or loss of that. The $10 is split into two $5 pieces. One $5 piece was an in-kind transfer, and the other $5 was a liquidated realized capital gain.
Right, and that segregates basically the basis portion or the cost basis from the gain. That's what you're talking about.
Absolutely. That $5 was then, that $5 had a cost basis and a market basis, and that difference is your realized capital gain. Cut and dry, very clear, as you alluded to.
That's a little bit different than I understood it. So that's very helpful. So
So,
go
Mr.
ahead.
Chairman,
Mr.
just one clarification on that, Kit. So I understand that $5 is a realized capital gain. So the in trading component, that other $5, where is that credited to?
So let me just be clear on the $5 piece. That was actually, we called the manager and said, sell those $5. We don't know from the manager how much of that 5 actually was realized or unrealized, because it depends on the securities they buy and sell. Let's say internally they go, we want to get out of, FANG or whatever, that's gone up tremendous amount. So there's a large amount of capital gains. Or what if they say, we want to get rid of some of the dogs that actually have a loss. So that's the part where we do not know until the transaction is done, how much of that was realized and unrealized. I just want to make sure you understand that.
Okay, but Mr. Chairman, that's not what I'm trying to get to. I'm trying to get to the transaction fees. So we've saved something because we've done that internal trading transaction fee. How is that credited to what account?
So, Mr. Chairman,
Out of the
Senator,
5 and the 5,
just to make sure that I'm clear, you're talking about the 5 from the manager, or you're talking about the in-kind transfer 5?
the in-kind transfer, the savings on that, how is that credited?
Pass that to Katie.
It's not credited because it never happened, but go ahead. Okay, before we move on.
But it's a real dollar.
Well, let's finish answering your question first as best you can.
All right.
Good morning. I'm Katie Smith. I am the Administrator of Financial Accounting for the State Treasurer's Office. To help answer that question, so the fee, as Chairman Perkins said, never really happened. So that doesn't get credited. It's just a savings of not having to actually initiate that with the manager. So when that gain comes through, we have to defer it because nothing has happened at the manager level. There has been no liquidation for those securities for that transfer from one pool to another pool or fund to fund. And so we have to defer that. Then once a liquidation actually occurs with the manager, we can reconcile that with our custodian and we can go ahead and absorb the in-kind that we distributed on a deferral basis first, give that in cash, and then be able to distribute whatever else is a gain, a realized gain or loss off of normal activity that the manager is doing every single month, every single day. So we have to defer it for the moment, and then we can recognize it later once we actually have a liquidation. So that's why for the portfolio, when you're seeing those to be distributed in kinds or an in-kind deferral that's hitting, it's not technically available yet, but it will be once we have a liquidation and we can absorb those. And we are in process of absorbing those as soon as we have a liquidation so that they're not sitting on the books for a long period of time and going over the course of years and years. We want those to be absorbed as quickly as possible.
That answer your question? Okay. Well,
We're not done exploring this, so we'll find for a while.
Thank you. So then Patrick or Katie, so going back to the 5 that we're moving over to be in the in-kind, we're doing that to avoid a management cost, right? Am I understanding that? So rather than buying the 5, we're shifting the 5 and we're doing that to avoid that cost. But then is there a point where you look at, would the realized capital gains on that 5, if we kept it over in A with the 10, is that more or less than the fee would be when we buy? Am I making sense there? There's got to be, do we weigh what the the realized gains would be and compare and offset it, compare it with the fee that we would have to pay if we purchased? Am I,
Mr. Chairman, can I butt in on that?
please?
So, I mean, what's going to happen is the fee never occurs. So that just means your net gain is bigger. And so because there was, if you have a transaction was $10 million, and you saved $1 million fee, then what you really have is you have a $10 million gain. Whereas if you netted out a fee, you don't have a $9 million gain. So it just increases the realized or unrealized gain. Does that make sense?
It does. I just.
So-
I understand what you're saying there.
So anyway, Mr. Chairman, Katie was gonna pontificate for us on this, so. Oh, that doesn't have a bad connotation. You're in the back office, you're the one that has to keep track of all this, so.
And we keep track of it as best as we possibly can on a spreadsheet currently. And we would like to have that all done within accounting software. But so no, we have to keep track of those and roll those forward. So the in-kinds that we're holding currently right now as deferred, say for last fiscal year, as we go through a rebalance, a quarter rebalance, normal activity with the manager, we're going to reconcile those actual gains so that we know that they're truly there. We'll pull back that cash and we would distribute that just like any normal distribution of gain or loss or income, right? We have to have the cash to be able to distribute that to the stakeholders. And so we're going to do that. But first, we're going to absorb what is sitting there already as the in-kinds for those stakeholders first. And then we'll distribute whatever else is residual after that,
Okay,
just like normal.
so Mr. Chairman, so backing up, and we'll just break this down, and because I'm quite dense, so I need to make sure I understand how this happens. So Fund A in our example now has a realized capital gain, correct? It's locked in because it traded those assets, it sold those assets to Fund B for whatever the market value was on the date of the trade. And so there is a capital gain that's now locked into Fund B, correct?
Mr. Chairman, so it's not, it's like a different perspective. So from a security perspective, yes, that's a realized gain. But from our perspective, from an accounting perspective, nothing has actually happened with the manager to be able to say that's a realized gain yet. So from our perspective, you have to have that manager liquidate for us to say that's a realized gain.
And therein, I think, lies the really big concern is that we've got spending policies. If Fund A has a spending policy amount, think Hathaway, think spending policy of the permanent trust fund, the permanent trust funds, think of pension spending policy, the Common School Permanent Land Fund. That gain is defined in statute as earnings or income. And so it affects from our side, it affects the ability to do that. And so this gets to the crux of the issue is we've got all these different funds and they have different spending policies, they have different purposes. And so as we make these gains, how do we account for that? And how does that affect the spending policy? I think the internal auditors have raised this question as well, or the independent auditors have raised this question. Well, because there is not necessarily cash generated on an in-kind transaction, but yet we've got these spending policies. So not just the accounting side, but the functional side. So
Mr.
help us
Chairman,
understand.
right. So Mr. Chairman, what we've done is we've worked with the state auditor's office to create some balance sheet accounts with the Wolf system that actually segregating these out. So it's not part of the cash balance that you're looking at when you pull up a cash balance for some of those funds for spending policy purposes. We've actually segregated those in-kinds away from that now. We're trying to be completely transparent. So that's not overstating maybe something that you think is there that's not there yet. And so we've moved those out. So then once a liquidation does occur, then we would essentially make journal entries and we would move what is being held in this, I call it deferred cash, but it's a holding zone of cash. We would move that into available cash once that liquidation occurs.
Okay.
So that you're only looking at your cash balance is true available cash for those purposes for spending policy.
But who, so is, are we, so when the position is finally liquidated, so the cash is realized, now we have gain that's spread across two funds that we have to account for. We've got the fund from which, Fund A, which there was some portion of gain locked in later, and if then there's another, if the asset continued to appreciate after it's moved to Fund B, and then later it's liquidated, part of that gain belongs to Fund B. Are we, and that's not what I heard you, that's not what I heard you say.
So exactly. So when that security would actually be liquidated, the gain that was originated off of that transfer from one pool to the other pool would be absorbed first. And then whatever gain was earned off of, after that would then be distributed according to who earned that after that. So it's going to be absorbed first before any other gains are distributed.
So if we come back to a spending policy, let's say it's Hathaway. And if Hathaway is not a good example, you can switch it to whatever fund would fit the example. But Hathaway, we've got to make scholarship distributions at the end of the year. Do we then go out and liquidate enough positions so that we have the money to do that? And is that when we do the true up, or when would that happen if it was Hathaway and we needed cash to make scholarship distribution?
And Mr. Chairman, that is what Patrick and I have been talking about, is trying to incorporate this as part of a rebalance. So rebalancings can cause in-kinds, but we also are going to have in-kinds on the books. So how can we incorporate that as part of our process where we can absorb those in-kinds as part of that next rebalance, so that they are not sitting there for a long period of time, so that you can meet your distribution obligations and things like that, and be able to have that as available cash. So it's a cycle that keeps coming around on itself, and you're constantly kind of chasing your tail with that, but we are coming up with a way that is going to be able to absorb those in a timely fashion, so that you're going to be able to have that cash to make your spending policy requirements.
So.
Sure.
We're rebalancing on a quarter basis. We're holding these retained receipts in a separate account. How often or how frequent do those then credit to that account to get back to the cash balance to meet are they quarterly, or are they annually, or when are you?
So, Mr. Chairman and Senator Hicks, currently, we pull back cash for income and gains and losses realized, the actual liquidation money. We pull that back monthly. So we would be able to reconcile that and look at that monthly. Keep in mind too, there's a lag of time, right? there is lags from the time of we earned it, pulled it back and distributed it, but it is on a monthly basis.
Okay.
When we're pulling that back and reconciling that.
Okay.
Go ahead.
Uh-oh, the CPA is going to ask questions.
Thank you, Mr. Chairman. One thing that would help the committee, and specifically me, it sounds like all of these transactions happen by journal entry. Is that right? Is that what generates this stream of?
Mr. Chairman
This
and
stream of-
Representative, yes, they are done through journal entry process as we integrate into the WOLF system, the state accounting system. So we hit a cash account and a deferred revenue account when those are distributed.
So, Mr. Chairman, so it sounds like there's a series of journal entries that account for this. So could you provide outline of what those journal entries are, just by title, where they go and how this flows through? That would help me a lot.
Mr. Chairman and Representative, absolutely.
Yeah, thank you. And Mr. Chairman, one other, just this conversation we've been having about spending policies. Is there a specific obligation of the treasurer for the treasurer to meet any spending policy requirements, or is this something you're just trying to accommodate? How does that piece of it work? How do you view the spending policies, and what's your obligation to those?
Mr. Chairman, Representative, I view it as we want to try to recognize the cash as soon as possible so that we can meet those spending policy. I want to be able to say this happened in this fiscal year, and this is what the distribution was off of the fiscal year activity. So as soon as I can do that, from my perspective, that's what I want to do. And hopefully we have those liquidations in place so that we can do that. As far as the responsibility of the treasurer, in that perspective, I will leave that
to him or
If I can
CIO
follow up,
Fleming.
Mr. Chairman, if I can follow up on that point, and I think that's really gets right at the heart of the crux of the issue is, you know, Fund A in our example has recognized or realized a capital gain because it's now locked in because the risk is now transferred to Fund B on whether that asset appreciates or depreciates. So the gain is whether it's booked as realized or unrealized is nevertheless locked in. And so under the statute, I mean, when we talk about earnings, it's dividends, income, rents, royalties, and capital gains. And so it has a direct effect on the legal definitions that we've got with respect to our spending policies and what we're generating at. And so I think this is, I think that, you know, this is really kind of a thing that has just started happening within the last fiscal year, I think, to any large extent. That's my
Mr. Chairman,
impression.
it's picked up speed.
Yeah.
It started in 2019 with a couple of them. And 2019 was my first year as administrator. And then in 2020, fiscal year 2020, they picked up more speed. And of course, as we're growing, as our portfolio is growing, and as we're, CIO Fleming and his crew are trying to meet all these asset allocation obligations and trying to make as much money as possible, these are picking up more speed. And then so in 2021, we also had additional ones. And so it's becoming more of an occurrence than it was in the beginning. It kind of was like under the radar a little bit. And so now we're uncovering all of the layers and really figuring out the best way to do this and how to handle it.
And so, Mr. Chairman, I think, I think this is really where the crux of the issue is. And I recognize we're trying to find a balance. It doesn't make, we have rebalancing requirements because of investment policies and things like that. We have to meet. So we're in a situation where you have to make a sale to rebalance, but one, it may continue to be a great investment. And if we can move that to someplace else because it's a great investment, hey, I get that, so, but the other side of it is the function and the purpose of the various funds is to meet these help meet these obligations. And so I think as we talk about this, there's a couple of concerns that come up and I think we need to talk about those. One is, this is now becoming, before it was probably somewhat immaterial, so it didn't matter, but now it sounds like it's becoming material, which means for transparency purposes and other purposes, financial reporting purposes, I think that when you do this, now we're going to have to keep track of this and you're going to have to include it in your monthly reports so that we understand what that is and it's fully transparent. So somewhere in our as we break down the gains and losses that we're recognizing in the funds, there's going to have to be some it doesn't have to be huge, but there's got to be some discussion of how much of the gains realized are from in-kind transactions.
And Mr. Chairman, you will see that in the June month-end monthly report. I did do that at a glance. I did separated them out. And because that's my goal. I want everything to be completely transparent. I want you guys to know exactly what you're looking at and what those gains and losses are, not just commingling them into one big bucket. So they are separated out. You have an income figure by pool. You also have a gain and loss, the normal gains and losses, realized gains and losses by pool. And then I also have an in-kind gain and loss. And then the total of what the earnings would have been for that fiscal year. So you will see that, and we will continue to delineate that out every month when we report the monthly packet. And we will also have it segregated out by fiscal year. So as in-kinds, unfortunately, those in-kinds are going to roll forward into this fiscal year. But I will make sure that those in-kinds that are rolling forward, what fiscal year they attribute to. And as those decrease down, because we've been able to realize those through liquidation.
And so that also then brings us to the other issue. So one, like I say, I think one of the things that we have to do as a committee is we have to decide whether we're going to define these as unrealized gains or realized gains. And I'm having a hard time how we would not recognize them as realized gains and how they would not go towards a spending policy or at least be counted as earnings. And I mean, they have huge effects because, this has been a tremendous year. And I think, we're going to find that we've met the 5% spending policies, or the spending policies have been met. There should, the realized gains that have occurred in the treasurer's office and the street trading y'all have been doing. I think we're going to find the reserve accounts full, and we may be looking at tips on some of those. And so, as we do this fund accounting, I mean, it's a big deal.
Mr.
It's a
Chairman,
really big deal.
It's it's a snowball and it affects so many things. It's a spider web for sure.
And so, and doing that, and then the final question is, and this is, and is, because I think I don't want this to be perceived wrong, Mr. Treasurer and Pat. But I think there's going to be a perception issue, because I'm assuming, because these calculations on these in-kind trades go into the calculations of what we've been able to achieve on our investment returns. And it's whether it's a 7% or an 8% or whatever it's been in. And so it logs into that. So it's got to fit into the compensation, the incentive compensation piece as well, as far as performance. And I think that creates a little bit of a perception problem, but maybe I'm thinking about it wrong. And so the first question, I think one of my questions is also, so when we have this gain, we've locked in this gain on this in-kind trade, does that contribute towards achievement of the incentive policy? I don't know why it wouldn't, but I'm assuming it would.
Mr. Chairman, a couple points is one, the question was asked about the spending policy and how much that we work on that. So Katie answered from the accounting side. From the investment perspective, our number one goal is the highest risk adjusted return. And if it meets the spending policy, great. But if it doesn't, it doesn't. And so as far as looking at realizing the gain to try and get to that spend, since 2015, I have never once, nor will I ever, unless I'm dictated to do so, doing that.
Mr. Chairman, and that's exactly where the investment office should be. But what you do in the investment office has a direct effect on the back office, as well as all the ways that these funds are set up. So I would never expect your office to do that, but so
yes.
But as we go back into the question about incentive compensation, do you understand when I talk
Yes.
about that there's a perception, when it's all great, it's great. When it turns out that there's a market correction, or the refinery blew up, or there's been a war there, or COVID, or we have another pandemic and the market tanks after we've made that transfer. Can you see the perception issue that public and others may have with respect to, they've locked in gain here, and then all of a sudden this one took a big hit because there was for whatever reason, it could be any multitude of reasons. Do you understand the perception problem that I think that we potentially have in that area?
So, Mr. Chairman, then point two on that. Well, another step back. The reason that this is occurring more frequently is just because of the process. We were 55% maximum in equities years ago. We passed Amendment A. We were able to move that up to the 70% threshold. So that necessitated the additional changes in the funds and more complex private markets and so forth. So that is part of the reason what Katie was talking about, as we progressively put on more risk and are enabled now to take on more additional risk. That has necessitated that. The other component of it is the cash balance. Cash is a drag, especially when the market goes up. From the investment side of it, we want to keep that cash as low as possible because of the drag. From your compensation part of it, our compensation is predicated on the total return, the alpha production of the fund. So that has nothing to do with the realized gains or losses. The second point on it.
Well, but back to that point, Patrick, is these in-kind trades are going to result directly in the investment performance. I mean, it's part of how you achieve the best risk. You're using it as a tool to achieve exactly what you said, the highest adjusted risk, risk adjusted rate of return. So it funnels into that. But can you understand the perception the public's going to have when there's a market correction, and all of a sudden there's incentive and benefit locked into Fund A, but all of a sudden there's a substantial now unrealized loss in the recipient or the acquiring funds a portfolio.
So, Mr. Chairman, let me make another clarifying point here, is just so everyone knows, this is not something that the treasurer said, we need to do this. This was predicated by the accountant. So they would take exception to your point of saying that, hey, from statute, our definition of income, right? Dividends, interest, and realized gain. Their definition of realized gain, we have not realized that gain. That's why we're doing this. MHP has said that is not a realized gain until it is physically sold. So if it's transferred from one to the other, their definition is no, that is not a realized gain.
Well,
So that is the issue here, is the accountants are telling us to do this.
if I was the recipient beneficiary of Fund A, I would beg to disagree, because you've locked in a gain for Fund A when you traded out those assets. You drew a line in the sand that I've now, I've got at least that much coming to Fund A.
And Mr.
Don't
Chairman,
disagree.
that is how it used to be recorded. It was recorded as cash. It was recorded like any other gain or loss. But then the auditors came and hence our
Because
findings.
there's no cash.
And they say, no, you can't do
I
that.
get that.
And so we have our findings. And so that's why we're here trying to comply with what they're being, what they're wanting, but also knowing that the needs and what we're trying to, have available needs to be there as soon as possible. So rock in a hard place.
So I mean, so have you thought about developing a policy about how long after one of these in-kind trades are made that you'll continue to hold those assets until you get to that point? Because at some point we have to true up, and we
Mr.
got to
Chairman,
allocate the proceeds across. And
Absolutely. And that's what CIO Fleming and I have been talking about, is doing this as part of our quarterly rotation, part of our quarterly rebalancing. However, we will have every month, we will have these pullbacks of normal activity that we can, we can absorb those there too. But if we can play a little catch up and a true up of sense on every quarterly rebalance, that would be ideal.
But Mr. Chairman, we don't know when we liquidate a fund, how much is in the capital gain. So if you said of that 5%, saying, hey, we need to make up that 5% because it's been a year, we would say, okay, sell, 100 million. And you're just hoping that 5% would be in a realized gain, but we don't know that. And we can't dictate to the fund to do that, because that's a legal liability that we can't take. So then you would sit there, you'd sell it and say, well, I hope it's 5. And you come back and it's like, well, it's only 2. Okay, well, let's do another 100 million. Oh, now it's 12. That is the issue. I agree with you the way that McGee Pies is doing this, because we have set them up with our counterparties in New York, and they don't do it this way. So all of these funds, PIMCO, all of these funds, they do in-kind transfers all the time. So if they're selling a security, if somebody liquidates, they do the exact same thing. Everyone does this, and they don't account for it that way.
well, I don't know if we're going to resolve this today, but it's
Go ahead.
Yeah, thank you, Mr. Chairman. Could we also have a look at how those funds do that, the way they do it? What you just said, Patrick, they do it a different way. Can we also see how they do it? Maybe the journal entries that they go through, so we can compare those two and evaluate that for ourselves.
Chairman Representative Obermuller. Yes, we have actually set up McGee Pies to deal with, for instance, Credit Suisse, because they are a bank loan manager and it happens all the time.
so.
And we could show you that how they account for those transactions, but they look at it by once that day, as I said, the NAV, or you have that security, you transfer it at that time. That's the equivalent of a sale to them.
Right, but back to your example, if I've got PIMCO in my portfolio and I say, I want a new whatever, and so I say you sell, I want you to liquidate $50,000 of my PIMCO because I want to buy a new pickup, and I've got a really nice trade because you can't get much of a pickup for $50,000 anymore. But anyway, I trade that in. I mean, and Granted, PIMCO simply has somebody else pick that up in their portfolio as they manage those commingled investments. But that certainly is a realization to me, and I take my $50,000 and I go plunk it down on my pickup. And so
Absolutely, Mr. Chairman, because just think how PIMCO does it. So they have, trillions under management. So every month they have buyers and they have sellers. So they just match them off, the buyers and sellers and whatever. If it's addition, then they actually will go into the market and liquidate. If it's, if they have to buy it, then they go in the market. And so, but otherwise they're just taking that portfolio, doing the in-kind transfer so they don't have to pay the bid offer spread. And so that is absolutely how everyone, and the accounting for it, I'm not saying everyone, I should say the vast majority of the people who I've known for 40 years, that's how they do it.
Mr. Chairman.
Go ahead, Andy.
So I'm kind of with Lloyd. I've got too many sticks being thrown into the water, but I think I'm catching on, but to put it in perspective, what are the frequency and volumes of these in-kind trades? Because we're talking about this hypothetical example of one trade between Fund A and Fund B, but in reality, what are we looking at?
that's at the end of June, if you know.
Mr. Chairman, and Representative Schwartz, the volume has increased. So as of last year, for fiscal year 21, we were looking at about 67 of these in-kind transfers throughout the entire fiscal year. And the result was around $140 million of gain. So that was as of last year. Now, again, if you go back to a prior year, it was far less as these are picking up speed, but fiscal year 21 was roughly 67 in-kind transfers, and about $140 million.
So what's the effect? And this may not be the right answer for you. This may actually be a question for someone that's sitting on this committee that used to audit these things. But what's the effect if ultimately if the legislature makes a policy that we recognize it where the gain is locked in and is paid, it is a realized gain as of the date of the in-kind transfer. So that it had to act like PIMCO selling off Drew Perkins's investments. What's the effect to that? I mean, I'm assuming, is it a footnote disclosure? Or are we non-conforming? Do we have them with a qualified? What's the net effect of that? I mean,
Mr. Chairman, I would be happy to take that to the external auditors and see how they would take that. I think we would probably be in a little bit of a pickle with that policy, but it's definitely something I would entertain going to them. It's all about the cash for them, right? There's no cash. So how are we able to recognize something that we physically do not have to distribute?
okay.
And that's where they're gonna go to every single time. And so I would be happy to entertain that for you.
If we go back to our PIMCO example, there is cash. It just comes from wherever the source is, because you've had other sales or you've got contributions coming in. It can come from, you've got instant, there's all kinds of, there's cash around. And so when you ask that question to the external auditors, the question is if there's a law that says that those are realized at the time of the in-kind transfer, what's the effect on the bound? What's the effect on the audit? Because it may violate gas, which is generally accepted. Was it FASB? No, GASB. Government accepted standing. Yeah, the Government Accounting Standards Board. It may violate GASB's principles in accordance with state law. So I think that's one question you want to ask your internal auditors. And like I say, a few years ago, I don't think it was a deal, but now it's a $140 million deal. And it's certainly becoming material.
Yeah, Mr. Chairman, I think we're all on the same page as far as wanting to make sure that these things are balanced out as soon as possible. And we definitely want to, at the longest date, I think would be a year on any of these things. And we're going to try to do it every quarter. And as Katie says, it's coming up on a monthly basis. So I think we are all on the same page. The problem is, as Katie said, is that if you recognize these, that there's no cash there and you can't spend it, so you can't go out and buy assets.
But if we recognize, we simply have to true up at the end of the year. At the end of the day, because that's when all the spending policies, all that stuff are figured out, is as of the end of the fiscal year.
and the sooner the better, Mr. Chairman, because of the risk associated with markets. And the markets that are inefficient, as Patrick said, in the privates and banknotes, those things, the transaction costs are quite steep. So, you know, there's a big game for it, and we just have to account for it right. We have to true it up as quick as possible. And we'll get you all of the background information on that and the look ahead.
Mr. Chairman, I think the other thing is just, I mean, you're gonna have to talk about this in your monthly results.
Yeah.
And in your annual results, so that it's, you know, it's just accounted, people understand it. Not that they will, but you know, it's disclosed, and then people have the, you know, they can go ferret it out.
Mr. Chairman, I hate to wade into the liquidation discussion by putting one more stick in the water, but I would speculate that the question to put to the auditors would be not that we would mandate that they keep their books out of compliance with the way the auditors want, but I think the auditors would say the legislature can define its spending policy however they want. They still keep the books the same way they keep the books. They just report to us what this amount of in-kind gain is. And then we add that to our definition of the spending policy. And then it's just a matter of their cash operations to make sure that the money's there.
That's exactly the point, but what you have is if the law defines an in-kind trade as a realized gain, then, you know, because it has a direct effect on spending policy, then it has to be counted as realized gain under law, but that's going to be in direct opposition of what our external auditor is saying. So if we do that, we just need to know what the ramifications of that would be.
But Mr. Chairman, I don't hear you saying we're going to tell you to change the way you do
No,
the bookkeeping. They keep the books the way the auditor says to keep the books. We just change our definition accordingly.
Well,
It impacts their cash operations.
if by law it's defined as a realized gain instead of an unrealized gain, that'll affect the way they keep the.
Okay.
Mr. Chairman, could I just make one point on it? This is just one example of why Senate File 121 is so important. To me, by far, the most important thing that we're doing. But if we're able to change our definition of income, all of this is negated. So that is by far the most important thing that we're faced in this session, in my opinion, is if we can change the way we define income, then it doesn't matter. You don't care about reserve policies. You don't care about all of these different issues. You're getting your spend and that's it. And then it frees up everything we do. We could then be looking at an endowment foundation. I know we're going to speak about this later, but I just want to point this out that this is by far the most important issue for me in how we do things.
Further questions? Go ahead. Lloyd?
But Mr. Chairman, I guess my question is then if we define that as capital gains, but we don't know what the capital gains are, then we're spending money we don't have? Is that right?
No.
No.
No?
You've locked in the gain in Fund A. The loss that
If there is
occurs is
one.
now transferred to Fund B. You know exactly what the numbers are in Fund A. In Fund B, you don't know until you finally until you actually sell the security.
Mr. Chairman, Representative Larson, the one we do get those numbers, but they're not instantaneous is what I was referring to. So when you were saying we don't know the gain, we do get them, but it's not that day. They don't tell us, oh, you just sold 100 million and 99 of it is the corpus and one is realized gain. We will get that, but it's at a delayed basis.
So, Mr. Chairman?
Go ahead.
The other issue is just a practical mundane issue, and that is, I mean, we've had a problem in that the trading office is getting pretty far out in front of the accounting office because we're not automated. We're still working on the automation issue. Is this, you know, are we getting to the point where you guys are so far out in front of the back office? Is this, I mean, that, you know, we want to continue to move forward in that area. We don't want to move backwards. And I'm, you know, Katie's got to mind her tongue here, but anyway.
Mr. Chairman, can I just comment on that? So Katie doesn't have to, but absolutely, that is why it is so, so, so important for her to have the staff, the systems, the people. And as we're seeing, you know, they're leaving. And we cannot lose these people with the small amount of staff that we have and the systems that we're slowly implementing. We have to have these.
Yeah.
We're $25 billion. This is not a little small fund.
No, I get it. Thank you.
So I'm curious because on the funds that go to B, basically the intent then is within 3 months or 6 months and no more than a year that they're going to sell those stocks, right? On your rebalancing component.
Mr. Chairman, Mr. Co-Chairman, in that we don't know when, but there's just a normal course of business. So we have every month we have bringbacks. So all these managers who want to have low cash balances, right? So they need to liquidate funds to pay this. They're not holding these monthly drawdowns. So that would then realize a gain if they had profited or whatever they're selling. So that would offset that. Quarterly rebalance. That would be another way every quarter when we do the rebalance. That would incur that McGee-Hearn Pie's definition of realization. Liquidation of a fund, that would necessitate the change. So there's all kinds of different things that we would have that would then allow Katie to do the realization. But you know, to say it's 1 year, what have you, we don't know, because if the manager loves Microsoft and is never going to sell Microsoft, and that's where the chunk of the gain is, then we would never get it. So that's the issue.
That creates some problems that we may be using. Is there an opportunity cost because we have to rebalance quarterly, that if we'd be better off if we've got something that's generating a revenue that now because of the rebalancing that we have to sell this, or do we keep that and sell some other asset within that pool?
Mr. Chairman, Senator Hicks, this is actually a very well-documented study, and we will send you the report that RVK put together that shows the benefit of rebalancing on a quarterly basis. So there's offset between there is transaction costs. So you don't want to do it daily. You don't want to do it every 5 years, what have you. But because the markets typically go like this, basically what you're doing by doing a rebalancing is you're selling high and buying low, because the time that you sell is when you have way out of your balance, right? The time that you buy is because the valuation of the fund has gone down. So you need to buy to add up. So it's a forced buy sell.
You can't just let it ride.
Go ahead.
But Senator, I'll show you the result, or the RVK report. They've done tremendous amount of work on this, and a great piece that explains the difference of rebalancing time.
Thank you, Mr. Chairman. Mr. Fleming, do you disagree? I think I've heard you say that you disagree with the position that your current auditors have on how to account for the in-kind transactions. Is that a right assessment of your position?
Mr. Chairman, Mr. Obermuller, that is, I'm not an auditor, but all I know is how other people have done this. And as soon as Katie told me this, I said, well, this is not right. And
That's not the word you used. Come on.
that is correct. That's not the word I used. I've been chastised before, so I'm trying to be very good here.
In fact, I can think of the two.
And
words
that
you
is
used.
when we set them up with Credit Suisse to show that this is not how it has ever been done that I've ever been aware of. That when a fund has that change, that is a definition, in my view, of a sell. But because it's not a physical sell, that you haven't gone into the market, they deem it differently. But I definitely adamantly disagree with their interpretation of what a buy and a sell is.
Mr. Chairman.
I have a question
yes.
for. I have a question.
Yeah, let me follow up, Mr. Chairman. So the primary responsibility for preparing your financial statement lies with you. So if you develop the professional backing from other credible sources that justify how you're accounting for it, and you believe your accounting methods are correct, that's the way you should prepare that financial statement. Then the auditors that you bring in, they must make the case that you have not accounted for it correctly. But they do not dictate how you account. You do that, and they have to challenge it. So if you have a strong authority for the position you're taking, that's the position you should take, and that's how you should account for it. Thank you, Mr. Chairman.
Mr. Chairman,
Go ahead.
I have a question for our good CPA representative. And so if I had 100 shares of Microsoft and I traded it to you for the equivalent shares of Caterpillar, equivalent value of shares of Caterpillar, is that a taxable exchange?
I'm not going to answer that question. I always hesitate, particularly since I've been out of the profession for 5 years.
I don't think the like-kind
The-
exchange rules extend that far.
I think you're
I
right.
think it's a taxable, I think for me as an individual, it'd be a taxable transaction. IRS would say I've realized whatever the value was on the sale of my.
Well, how far do they
Microsoft.
go then? If you trade a horse for a cow, is that in-kind exchange?
No, it's not. Real estate for
Well-
real estate is, but personal property is way different. It's
Oh,
really
yeah.
restricted.
Yeah, all those rules on like-kind exchanges are different in every circumstance, so
Yeah.
it's always, it depends is the right
What if you
answer.
transferred those to your wife?
Well, there's no tax effect because it's my wife.
But if
But
you have two separate accounts,
if I transfer them to Senator Nethercott, there's an effect.
but if it was transferred, physically transferred to your wife's account, you had two different accounts. I'm not talking about taxable transaction, but they would then account for that, the buy and sell for your account at that point.
Sure. If my wife had a separate account
Correct.
at our investment advisor, we both had two separate accounts and we did that. Yeah, it would be accounted for. It would show up in my annual reporting as a transaction. It'd be up to me to make the internal accounting to figure out whether it wouldn't report it.
But it wouldn't be
appropriately.
taxable.
Well, it may or may not be. It
But it's
depends.
yeah,
Well, you make your wife
anyway,
pay
you-
it.
You see my point.
But yeah. So again, that goes, it go back to section 1031 and whether it was a like-kind exchange or not.
One last point, it would be interesting to see if other accounting firms in the city would have the same view as MHP.
Yeah, go ahead and shop your accounting opinion. We'll see how that works out.
A little venue shop.
Go ahead.
Just a little pushback from that last statement. This is the same idea as in dealing with major surgery with a doctor, the idea of getting a second opinion from a credible source. It's not shopping your ideas. Go to somebody like Deloitte and say, we want to pay for an opinion. You write us an opinion on this transaction. Get a professional written opinion that you pay for from a credible source. Thank you, Mr. Chairman.
Go ahead, Kate.
Just, Mr. Chairman, just really quick, I want to make a comment. So these discussions are not over with the auditors. They have just begun. I go into very healthy debates with the auditors continually about things. We are still collecting and discussing internally as well on our stance and how we feel. However, I do not want to be in a position of having another audit finding on our financial report due to the way that we're recording these. So we are trying to record the way that we are being told is the proper way to record, as well as doing our own due diligence and having those healthy debates with the auditors to ensure that we also feel comfortable with that type of way of accounting for those transactions.
Well, it ought to be relatively easy to get some of the other funds that do this and work with their back office and find out what accounting advice they have received and how they do it. And use that as your explanation. And
And
that
Mr.
should be
Chairman,
relatively simple thing.
Mr. Chairman, I have talked to Credit Suisse. I did not get the same answer. So we're working with them that Patrick has had with them. I am talking internally with some of these managers, also with my investment accounting manager. We're trying to get those journal entries, get those practices of the same type of in-kind. There are several types of in-kind transactions. This is a specific type of an in-kind transaction. So just making sure we're comparing apples to apples.
So I'm curious, just going back, Patrick or Katie, you said there were 67 in-kind transfers that represented 140 million in gains. Is that right? Or $140 million in securities,
Gains.
in gains. So how much were the securities?
I would have to go back and look at that for you,
It would have to
Representative.
be fairly substantial. It would have to be
It was, I think this around the 500 million.
500 or 600 million.
Wasn't it?
And so you did that before June 30th, right? And we're past the
Yes,
first,
Mr.
we're now past the first quarter. How much of that has been, have you sold that you transferred?
Mr. Chairman, we're still in the process of finalizing our rebalance. So I won't have that number right off the top of my head. We're still
But-
finalizing all.
But
of the
roughly how
funds.
much would be? 30%, 40%?
Well, part of the rebalance, Mr. Chairman, part of the rebalance caused more in kinds. So I need to add those to the tally and then go back and see what that would be. And we
Well, you don't
will,
need to add
Mr.
'em.
Chairman, we
Because the
won't
question
know.
is how much of the in-kind trades you did in June have then been sold to the transferred account.
And Mr. Chairman, we won't know that either until we get the statements back from the managers after this rebalance and we're able to reconcile those with the custodian, which will be in October.
Yeah. then July.
Okay. So what we'd like to do, obviously, like we talked about it, but we'd like to get better educated on this and understand it better. So as you get more information, hopefully you'll provide it to us. Go ahead.
Mr. Chairman, maybe it would be beneficial to the committee at some point to be able to do this with a whiteboard or something, because there's a lot of moving parts and sometimes I'm having a problem visualizing this. So just a thought.
Well, I think the way to do that would be to do it informally.
Get it.
And not maybe as a whole committee.
That is glass.
Either have a working group, just go sit down and have them do it. Otherwise, we'd be doing it all day.
Let's zoom with Patrick.
We could do.
It's not Patrick, it's Katie or somebody on Katie's staff.
Well, how's her whiteboarding skills?
I'm sorry,
How are your whiteboarding skills?
Mr. Chairman, Senator Kinsey, they're fabulous.
All right. We'll set something up let's set something up.
Okay, we've gotten a little
for
bit
those
behind
interested.
schedule, but
Yep.
Any further questions? You all set? All right. Anything else on number 2? Operations and in-kind transactions.
No.
Seeing none, we'll go to, what time is it? No, we've only been here an hour. Do we need a break?
Mr. Chairman.
Yep.
There.
Yes. Let's go to Senate File 121. Number 3. Study preview, LSO staff. Who's up for this? Ian. Brian.
Chairman, thank you. As you indicated, we'd like to give you an update on the Senate File 121 study with Brian Fuller. I think you know, a senior staff attorney at LSO, and I'm Ian Shaw. Sorry, speak into the mic. Seth.
Yeah, we can't quite hear you.
My name's
Room
Ian.
is echoey and.
Right.
So,
Okay, very good. My name's Ian Shaw. I'm the legal division administrator at LSO. The first thing, you know, at the last meeting, we talked a little bit about the 121 study and we had an outline of what it requires, but I'd like to remind you of some of the basic requirements. It's a 2-year study to consider the status of Wyoming's investment law and to consider changes necessary to allow improvement to Wyoming's investment policies. The study requires consideration of the Wyoming Constitution, our Act of Admission, and our statutes, and consideration of the state's duties, particularly trust duties, in holding and investing funds that belong to the people of Wyoming. It requires an analysis, ultimately it requires analysis of both our permanent funds and our non-permanent funds. For purposes of today, we're going to talk about the permanent funds. We're not going to talk about the non-permanent funds or the workers' compensation fund, because those funds have significantly different issues and don't have constitutional and active admission bases. So we'll be primarily focusing on the Wyoming Permanent Mineral Trust Fund, the Permanent Land Fund and its Common School Account, the Hathaway Scholarship Endowment, and then the Excellence in Higher Education Endowment. Now, we did provide to the committee a memo on Tuesday of this week that sort of outlines some of these issues. Please recognize that that memo is not intended to constitute the 121 study. Instead, it's really intended to be an identifier of the issues that we think that the committee should consider. I think you'll realize when you look at it that the memo doesn't provide firm guidance from LSO on what should be changed or could be changed in the statutes or in the Constitution or in the Act of Admission. And that's partially due to the fact that the committee hasn't made some of the decisions that would be necessary to do that. If you want to know what needs to be changed, then we need to understand a little bit about where the committee wants to go and or some of your preferences for an ultimate investment practices. So the first thing we're going to start with is a consideration of what laws applies to these funds. Brian is going to talk about that. We should at some point have a spreadsheet up on the monitors. That's included in your materials. It's a large spreadsheet that talks about the different laws that are applicable to each of the funds, and then a lot of other considerations that are specific to each fund. I hope that when you look at that, you'll recognize that each one of the funds is subject to considerably different circumstances, constitutional and statutory language. And before Brian gets started, I just want to bring up the prudent investor rule that we've talked a little bit about and that Brian will talk about as well. It specifically requires that when considering the management of our assets, that we consider the purposes, the terms, the distribution requirements, and other circumstances of the trust that we're talking about. I think that that is a further indication that we have to consider each of these funds separately. With that, I'm going to turn it over to Brian, who will discuss that spreadsheet.
Thank you, Mr. Chairman. Brian Fuller, LSO. I'm going to focus most of my comments right now on that first row of the spreadsheet on the first page for the permanent funds. These 5 funds have some common features. First, they all reference that the funds are inviolate or permanent or perpetual. All of the funds include provisions that specify what can be used or what can be expended in terms of income, interest, or earnings. And they generally specify the object of what those monies can be expended on, except for the Permanent Mineral Trust Fund, which just states that that income goes to the general fund. But each fund is different in terms of the purposes and the requirements for what can and cannot be expended. And the big takeaway I would share from this is that because these funds have different enabling language, different histories, different characteristics and requirements, and different limitations, each fund should be analyzed and interpreted and considered separately. In terms of whether, what changes should be made to an investment model for those funds. Each fund is going to require different changes to different provisions of law, both state and federal. So starting in the spreadsheet, I'll just run through the law for each fund, and I'll start with, just the general inviolate funds. Article 15, Section 19 for the Permanent Mineral Trust Fund just specifies that the fund, including all monies deposited in the fund from whatever source, shall remain inviolate. That provision, that section requires that all income from fund investments shall be deposited by the state treasurer in the general fund on an annual basis. For the education endowments, so the Hathaway and the Excellence in Education, this is Article 15, Section 20. And it provides that the legislature may place monies into endowment funds for higher education scholarships and for improving the quality of higher education, which funds shall remain inviolate. And slightly different and unique to this section and these funds is that in addition to specifying that the funds can be expended on these higher education purposes, it also states that the legislature may also provide for the use of earnings to protect the funds from inflation and to even fluctuations in earnings over time. With one exception that I'll discuss later when I talk about the common school account, this is the only express language in the Constitution that expressly contemplates inflation proofing a fund or smoothing out fluctuations.
Go ahead.
Thank you, Mr. Chairman. Where is the reference of that on here? I just wanted to make a notation on it. Oh, it's okay.
Yep. So that, Mr. Chairman, Representative Obermuller, should be on the far right, should be the language of Article 15, Section 20.
Thank you.
And then, Mr. Chairman, moving on to the permanent land fund and the common school account. Before I explain these provisions, I just want to share a brief bit of background about this fund and the act of admission in which the permanent land fund has its genesis. The Wyoming Supreme Court has noted that Wyoming's act of admission has a unique history. And the reason that it's unique is that unlike most other states, Wyoming held its constitutional convention before Congress drafted its act of admission. And so when the drafters of the Constitution were drafting these provisions, they had to simply assume that Congress was going to grant land for the establishment of a permanent fund for school purposes, as it had done in other states. Other states' constitutions, more directly spell out how funds can be expended because it's based on the act of admission, which they had in hand before they drafted the Constitution. And so this history, this background is helpful in considering Article 18, Section 1, and that's not on the spreadsheet that you have. But in this section, the state agreed to accept the grants of land that were previously made or that were to be made by the United States to the state of Wyoming for educational purposes, quote, with the conditions and limitations that may be imposed by the act or acts of Congress making such grants or donations, end quote, of money or of land to the state. This section, the court has stated that basically shows and establishes there's a solemn engagement on the part of the state to adhere to the conditions that were imposed in the act of admission. And I'll discuss more about this later when I talk about the question of a trust or trust obligation and a fiduciary duty on the part of a state. So just running through the act of admission for the permanent land fund and the common school account, Section 4 of the act of admission granted 2 sections of land in every township to the state for the support of common schools. Section 5 provided that all of these lands that were granted shall be disposed of only at public sale, the proceeds to constitute a permanent school fund, the interest of which only shall be expended in the support of said schools. There's an explicit reference in the act of admission to the term interest. Section 7 provided that 5% of the proceeds of the sale of any federal land within the state are to be paid to the state to be used as a permanent fund. And then once again, the interest of which only shall be expended for the support of the common schools within the state. Section 8 addressed proceeds of certainly previously granted lands for university purposes. And that section states that those proceeds shall constitute a permanent fund to be safely invested and held by said state, and the income thereof be used exclusively for university purposes. So the act of admission, and I'll discuss this later as well, there's a distinction in the use of interest and income, which may be relevant as this committee considers what changes need to be made to different terms that are used. And then finally, for the act of admission, Section 12 noted that any lands granted can only be held, appropriated, and disposed of exclusively for the purposes herein mentioned in such manner as the legislature of the state may provide. Then moving on to the Constitution, I've already discussed Article 18, Section 1. Article 18, Section 2 provides that the proceeds from the sale and rental of all lands that were donated, granted, or received shall be inviolably appropriated and applied to the specific purposes specified in the original grant or gifts. And then Article 18, Section 6, which is not on the spreadsheet, this section states that if any portion of the interest or income of the perpetual school fund be not expended during any year, said portion shall be added to and become a part of the said school fund. That section, Mr. Chairman, I haven't had great time to analyze what that means. There's no case law really discussing this section. It seems at a minimum to contemplate some sort of inflation proofing, given that it would put the income back into the corpus of the fund. But that's, unclear at this point.
What was it for in perpetuity, just for the year?
So if it would be any portion of the interest or income of the perpetual school fund be not expended during any year, said portion shall be added to and become a part of the said school fund.
So it doesn't tell you the end.
Mr. Chairman, it's not clear, no. Then moving on to, Mr. Chairman, to the school fund provisions, these are in Article 7. So Article 7, Section 2 states that certain lands are declared to be, and the proceeds from which are declared to be perpetual funds for school purposes, of which the annual income only can be appropriated. And then Article 7, Section 6, this is actually on the second page of the spreadsheet, the reference. This section states that all funds belonging to the state for public school purposes, the interest and income of which only are to be used, shall be deemed trust funds in the care of the state, which shall keep them for the exclusive benefit of the public schools. This section is the clearest reference to a permanent fund being a trust fund, and suggesting that there's possibly additional duties on behalf of the state to maintain those funds. And then finally, Article 7, Section 7 provides that the income arising from the funds, together with all the rents of the unsold school lands, shall be exclusively applied to the support of free schools in every county in the state.
Go ahead.
So Brian, did I catch this right? The act of Congress said for the PLF and the CSLF, I thought you said interest, only the interest can be spent. But when you pivoted to our Constitution and it talks about those same funds in the context of schools, it refers to income being appropriated rather than interest being appropriated. Do I have that right?
Mr. Chairman, Senator Kinsey, that's correct. Our Constitution does include references to income, whereas except for one section of the Act of Admission, I'm dealing with the university portion.
It dealt with income.
That section dealt with income. The remaining language uses the term interest.
Okay. Do you have a separate memo on this analysis?
Mr. Chairman, Senator Kinsey, that should be, there should be a 14-page document.
Is that from the last meeting?
No,
Exhibit
Mr. Chairman, Senator Kinsey, this is from this
document.
meeting.
Okay. Gotcha.
Mr. Chairman.
Go ahead.
Thank you, Mr. Chairman. Is the word interest just interpreted broadly because it was written when interest was the only form of income at the time, or how do you interpret that?
Yeah, Mr. Chairman, Representative Obermueller, I think that's a question that we would still need to do some more digging. Exactly what is meant, or what Congress meant by the use of the term interest, keeping in mind that this was drafted in 1890.
Thank you.
And then moving on, Mr. Chairman, the last thing I'll note on this spreadsheet for now is the fourth or fifth row on page 1, the beneficiaries row. And generally the information in this row just goes to show the purposes of each fund or the objects of the fund for which the interest, income, or earnings may be spent. And each of these funds have a different object and different purpose that I think that the committee should keep in mind as it's considering changes for each of these funds. The Permanent Mineral Trust Fund, probably the broadest, just says that the income goes to the general fund. The permanent land fund and the common school, both in the Act of Admission and Constitution, it's the support of the common schools. For the Hathaway Scholarship, it's generating ongoing income for those scholarships. For the Excellence in Education Endowment, it's salaries for the endowed faculty and support the work of the University of Wyoming and the community colleges, the latter of two being in statute. With that, Mr. Chairman, before I move on to the memo, I'd be happy to answer any other questions about the spreadsheet.
Could you make it a little bit bigger print next time?
Will do, Mr. Chairman.
Bigger piece of paper.
Yeah, that's what they're gonna have to do.
Poster board, Mr. Chairman. So then, Mr. Chairman, moving on to the memo itself, and Mr. Shaw and I will cover different issues that we have identified that the select committee should consider as it contemplates a change to the state's investment model for these permanent funds. The first issue that I'll briefly touch on and discuss is this question of whether any of the permanent funds would constitute a trust to where the state would owe some sort of additional duty, i.e. those of a trustee, in managing and operating the trust and distributing income or interest or earnings from the trust. For the permanent land fund and the common school account, I would note that Article 7, Section 6 clearly states, and the Wyoming Supreme Court has noted this and discussed this in case law, that those proceeds from those land sales are trust funds in the care of the state, which suggests that there is some sort of heightened duty in managing those funds. Article 7, Section 2 similarly says that those funds for the common schools are perpetual funds. And then in statute in 94204U4, that paragraph notes that the permanent land fund was created to, quote, account for the resources received and held as trustee of the land grants made to the state by the federal government. More broadly, though, Mr. Chairman, I think beyond that specific fund, there's some question as to whether there's a trust or not. And to that note, I would say that the legislature, both in the Constitution and in statute, have at least contemplated that there is some sort of trust. Article 3, Section 38 notes that the legislature may authorize the investment of trust funds in stocks and equities. The previous iteration of that section precluded the investment of trust funds in stocks and equities. In terms of Wyoming statute, 94715 and 94716, which concerns the investment and the creation of investment policy statements, reference, investment strategies of the trust or the fund, or the creation of those statements or, quote, state funds for which there is a trust obligation. So the legislature has contemplated that and, or signaled its belief that at least one of the funds does constitute a trust. And then finally, in terms of case law, the Wyoming Supreme Court has held that at least in terms of the lands that were granted to the state, that the Act of Admission does not impose trust duties, nor does the Wyoming Constitution impose trust duties on the state regarding the granted lands. But that a non-codified statute that was enacted in 1997 does subject the lands to a legislatively created trust. In terms of the proceeds, the only reference would be, again, Article 7, Section 6. With that, Mr. Chairman, I'm happy to answer any questions on this issue of trusts and whether the funds would constitute a trust.
Other than that, we'll move then to another question in the memo, and that is one that's not new to the committee, but it's a question of what it means to have these funds be inviolate. As Brian has kind of gone through a lot of the language applicable to each one of the permanent funds, but they use different terms to potentially express the same idea. They call these funds inviolate, permanent, perpetual, or inviolably appropriated. And I think Brian's already done an adequate job of describing that each one uses a different term. And for the purpose of this discussion, I'm just going to use the word inviolate, that the permanent fund should be inviolate. But what does that mean? I mean, it clearly means that they shouldn't be violated. But if we look at Black's Law Dictionary, it says that they're free from violation, not broken, infringed, or impaired. Valentine says that it's unhurt, uninjured, unpolluted, and unbroken. We do have some Wyoming case law on the subject, although that's in the context of our inviolate right to a jury trial, but it describes the meaning of that word as that it means the subject cannot be hampered either directly or indirectly. In our memo that we discussed, we identify how some other states have interpreted that law, and some of their interpretations are very strict on what the word inviolate means and the duties that it places upon the preservation of those trusts. Well, some of those definitions might lead us to the conclusion in Wyoming that our funds are inviolate and can never be touched, applied outside of the funds or invested. And if we just take a quick look at the Wyoming law, that can't be the case, because inviolate doesn't mean that they're simply locked up. If we look since 1996, Wyoming has had the ability to invest it in equities. Clearly then those investments the fund corpuses can be invested at least and don't need to be locked up. And the actual text of our Constitution obviously allows us to apply income or earnings or interest to things. So the earnings from those funds don't have to be locked up. So that leads to the question of what does need to be locked up. And I think if you can spend interest and you can invest, then it probably means that the corpus, whatever that means, is inviolate. It means that there is some level of the corpus that can't be invaded. The exact requirements for the treatment of corpuses, though, is not clear in Wyoming law exactly what it means. So to dig in that issue, we can start looking at some of the Wyoming's investment practices and the impact of the use of the terms like inviolate on those practices. And the first one of those is whether or not the state can make sales at a loss. That is the question. If a fund is inviolate, does that mean we can't make sales against it that incur losses? We don't need to spend a lot of time on that because both our Constitution and our statutes speak to that. So the legislature has at least given us its interpretation. As I mentioned, since 1996, the Constitution has allowed authority to invest in equities. There is some authority, including a 2010 AG opinion, that would indicate that authority to invest is also the authority to make, or at least implies an authority to make sales at a loss. But the legislature, as I said, has already spoken to that. Since 2008, we've adopted the total returns policy. And as part of that, it says that it allows the treasurer to make sales or exchanges at a loss when the sales or exchanges maximize total returns and when they're consistent with our investment policies. So the legislature is clearly given an interpretation of the word inviolate. But the fact is that statutory law cannot trump any sort of a constitutional prohibition against sales at a loss. Well, of course, our Wyoming Constitution doesn't have a specific prohibition or allowance of sales at a loss. Instead, it's silent.
Mr. Chairman,
Please.
so, as you talk about inviolateness and losses in the corpus. So even if you go to the permanent land fund, and we're talking about trading, but there's other kinds of losses, obviously, that can happen. You can have some kind of casualty loss. You could have let's say that you've got a state, let's say, what is it? Didn't the state land fund buy what's that ranch out of Douglas in the Northern Army Range there?
Mr. Chairman, I don't know the name of the ranch.
Anyway, that ranch. Let's say that they've got a fire that goes through, wipes out the timber, wipes out all the infrastructure, wipes out the buildings. There's obviously a loss to that land. That land is no longer worth what it was worth before because the fire damage and loss of the structures. And let's say insurance it was insured, but the insurance didn't cover it. There's other types of losses. Would those types of losses have, if you draw that conclusion, those losses have to be replaced or recovered because they were part of the corpus, or did they not?
Sure. And Mr. Chairman, I think that's correct. I think that the historical context, even before we were allowed to invest in equity, shows that there were losses incurred in some of our investments, although maybe on a slower pace than modern investment practices. But certainly, I think there's no way to interpret, it shouldn't be quite that strong, but it's unlikely to interpret our constitutional obligations to never incur any loss in any one of the investments that we make. And in fact, I'm sorry, I don't remember the specific case citation, but there was a case earlier in Wyoming, I believe, that even mentioned that as long as our assets are adequately insured, that meets the state's obligation. Again, in acknowledging the fact that there may be some losses even to our physical assets as well as our investment proceeds, et cetera. So historical context is absolutely accurate. And in fact, if I'll say my next statement, because that kind of reads into it, and that is that LSO has located no Wyoming authority that would disallow the sale of some investments at a loss, where there is constitutional authority to make the investments, where there is a long-standing history of buying and selling investments, sometimes at a loss, to maximize returns, and when the legislature has adopted a complex statutory structure that supports those practices. There's just really very little evidence that Wyoming, even though it's not specifically contemplated in the Constitution, that sales at a loss are not allowed. So I don't mean to spend too much time on that, because I think that's not established in our Constitution, but likely is a fact of Wyoming's investment policies that shouldn't be disputable. But now to a potentially a more complicated issue, and that is whether the state has an obligation to make whole losses that are incurred, and if so, at what point you have to do that. Again, the legislature's talked to that issue. Just last year, we appear to have adopted the Meyer rule, which I think the committee has heard about.
Treasurer's interpretive policy.
Indeed, right. The Treasurer's interpretive policy, which now appears to be set in statute. It says, it talks about netting losses against gains. It says any debt against a state fund that exists because of realized capital losses from a prior year's investments must be netted against the realized capital gains before distributing those gains. So there is a required netting of capital gains against capital losses. Now, interestingly, though,
Mr. Chairman,
Go ahead.
so what about in-kind gains?
Oh, boy.
No, I'm kidding. I'm kidding.
That was the folks before me. I'm not going to weigh into that with a bunch of accountants, et cetera. Yeah, no, thank you. I apologize. Interestingly, though, that netting policy excludes dividends and interest. And that could be important for this committee's consideration of our obligation to reimburse all losses when we specifically, reimburse all losses when we specifically exempt some gains from being netted. So it's clear that the legislature.
Go ahead.
Dividends and gains as being captured under the Meyer rule?
I'm saying that the statutory provisions that we adopted last year require the netting of capital gains against capital losses, but they don't require the netting of interest and dividends or rents from those capital gains, capital losses.
Thank you, Mr. Chairman. Correct me if I'm wrong, but that was the whole idea of the Meyer rule, was it not? So that interest and dividends were still distributed. Otherwise, you had no distribution. And that was the workaround.
Mr. Chairman, that is correct. And the Meyer rule announced a change to the historical treatment of netting, because prior to that time, my understanding is that we're netting all gains against losses. So the Meyer rule represented a change to that policy.
Mr. Chairman. So, Mr. Chairman, I was on the CAPFIN when Treasurer Meyer did that rule, and we, what year was that? It was 2007, 2008, somewhere in there. And we had just come through a significant downturn, and we were in CAPFIN and we were discussing these issues, and if you didn't have that rule, the net effect was that, obviously one of the things that we were hoping with, and there's been particularly back at that time, part of the investment policy was to invest in equities and other income that were counter-cyclical to the commodity resources that we have in the state. And so one of the ideas was that it would help to smooth out some of the ups and downs in the income flow out of that thing. And so we got into this big discussion about whether or not you would offset capital losses within interest and dividends. And what we found was that really, if we didn't do that, it exacerbated the swings that you had in income out of the cycle. When the market was down, you would have zero or no income. And if you had the same markets, and if the if that coincided with the drop in oil prices and things like what you saw just last year with the pandemic, that, you know, it actually exacerbated the deficits as opposed to help smooth them out. So, I mean, we had a long talk about that, and that's when Treasurer Meyer came back with that rule. And anyway, we codified it last year. That's just, Mr. Chairman, that's just a personal diversion. Sorry, just walk down memory lane.
So, Mr. Chairman, with that,
Swinging our
then,
hands, laughing and singing.
so what we have is a legislative policy then that requires some netting of losses against gains. And I think I need to bring up a 1969 constitutional amendment that was adopted by the people of Wyoming that did the opposite. And in that constitutional amendment dealt with the common school account. It amended Article 7, Section 6 of the Wyoming Constitution to strike express language that required the state to make good any losses that in any manner occurred, so that the permanent school fund shall remain inviolate and undiminished. So it's interesting in that we amended the Constitution to remove entirely those repayment obligations, in contrast to a statute and the Meyer rule that we've now adopted that at least requires us to repay some of those losses by netting gains against some losses. That's interesting. And I think the two can be read together to indicate this, that the state doesn't, or at least this is the interpretation that the legislature may have, is that the state doesn't have an absolute duty to repay all losses incurred in the investment of state funds, but consistent with the new statute 94108 does have an obligation at least to net investment earnings against investment losses. And I think that's my interpretation of where the state is right now on that issue. There's a more difficult question, though, it exists on this issue, and I think it's one of the key questions for this committee. And that is that assuming that the sales at a loss are permitted and that the state is not always required to repay those losses to the permanent funds, what happens if we don't repay those losses and they eventually accumulate to the point where they are infringing upon a permanent funds corpus? That raises the question of what does it mean to impinge on a corpus, and what is the value of that corpus? As I said, that's not necessarily theoretical, because after the Meyer rule, it made available more funds for distribution, but at the same time required less netting of losses. And so potentially increasing in a down market, the deterioration of a fund potentially down to its corpus value.
So, Mr. Chairman. So if you have a collapse, Great Depression came probably close to a fairly decent collapse back, was it 2018, 2019? Or excuse me, was it 15, 16? When we had the financial meltdown. And so, there's been Black Mondays and all kinds of things where you see significant drop in the market swing. So so if you have those, in my mind, there's no question that you've got losses that impinge on the value of the corpus. If you have a 50% drop in the market, there's no question you have an impingement of the corpus. So how does that feather into the comments that you're making now?
Right. Well, Mr. Chairman, and that is indeed above my pay grade and probably more in yours as an accountant in terms of whether unrealized losses and gains do count towards the value of a corpus. And I think that's what I'm maybe getting at is that the answer to those questions is entirely unclear in our law and in the Constitution. Some states have taken the course of trying to define what losses mean. I believe Idaho is one of those who has gone ahead and done that. But right now it's unclear what that means. And it's very important to what this committee is doing. If the committee adopts investment strategies or new processes that might free up some more of a permanent fund to investment or distribution, then a real question exists as to what is the value of a fund and at what point we evaluate it. The value of the fund likely dictates what losses can be netted and what can be distributed. That question alone, and I don't know that Wyoming has ever engaged in a debate or that there's a current debate about what the value of the fund is. But that's also easier in a market like we have today, where we don't really have to worry about it. But should we go through another downturn, or should we loosen up our investment strategies to get more at what the corpus is? That might be an issue. And that's, I think, something that deserves, continued analysis by LSO, and that this committee probably needs to wrestle with as we go forward. I did want to mention a couple of things, and that is that in that analysis, I mentioned a 2010 Attorney General letter. It's interesting. In that letter, it was considering the Agricultural College Permanent Land Fund. In finding that there was no absolute duty on the state's part to make whole losses, particularly that the Constitution then allowed investment in equities and adopted the prudent investor standard, the AG opined that the state does have an obligation to make whole losses when the losses go below the initial amount of capital raised by the sale of the lands granted to the state. And it provided an example, which maybe factually is obvious, but it's interesting. It said that if we took our state lands and we sold all of them for $100,000, regardless of when those sales were made, then the state is obligated to maintain the $100,000 at all times. It's interesting. It means that no matter what the timing or inflationary factors, et cetera, of that initial corpus of the fund, that's what the corpus represents. It's $100,000. I think I also mentioned that other states have taken a different tack towards that, like Idaho. Idaho benchmarks the value of their corpus of their endowment funds to a June 30th, 2020 date. And then it adjusts it for inflation and other deposits into the fund. And it sets a floor on those endowments of that 2020 value plus a specified amount of deposits into the fund. But it specifies what those are. I might also mention, because we've talked about it, they define in their statute the formula for calculating losses, so that it's not a mystery, or so that it's clear from their constitutional provisions what those losses are. I don't have the same amount of detail on Utah, but I would mention that Utah also the Constitution gives authority for statutory determination of the market values of their permanent funds.
Mr. Chairman, was the two questions. First one was the Utah one. Is that the one that when they just redid the Constitution as far as investment, just like last year, or is that what you're referring to?
Mr. Chairman, I'm sorry, I don't know. I believe so, but I didn't do the statutory research to make sure. I know that it's there now. Brian, do you know that?
Mr. Chairman?
Go ahead.
Ian, but we on some of our permanent funds, like when we determine the value of the PMTF, it's done on an annual basis, right, to determine that 5-year rolling average. And so then we reestablish what the value of that corpus is that at that time. Is that right? Or is it a different?
Mr. Chairman, Representative Larson, that's correct, but that's for the purposes of our spending policies. And I think that's pretty well set out in those spending policies. The core question as to what the value of the corpus is may be a different question, and maybe a different answer. And I'm not suggesting that it is. I don't at all need to suggest that we have misvalued our corpuses or that there's a clear answer. I'm just, we have an AG opinion from 2010 that suggests what the original value is all that could be. So there's a question there.
Follow up, Mr. Chairman. So just using the PMTF then, because we have that growing all the time, we're not picking an original amount, right?
Correct. Mr. Chairman, that is correct. And that's important with the Permanent Mineral Trust Fund because it has a continuing source of investment in the corpus. Unlike some, you look at the Permanent Land Fund and the fact that the corpus is the original lands plus the investments and rents and et cetera, royalties that come from those lands is a lot more complex question. But you're right, the Permanent Mineral Trust Fund is likely an easier determination, at least to the extent that regular deposits are being made to that account. And I think it's undebated that those become part of the corpus, and that's where they're deposited.
Mr. Chairman, I wanted that Brian had something he's going to say, I think.
Yeah, Mr. Chairman, I don't know the exact year. I think it was within the last 5 or 6 years that Utah amended their constitution. And then these statutory provisions in Utah where they've defined, like the annual market value of a permanent fund. I think they've amended those every year for like the last 3 or 4 years.
Mr. Chairman.
Please.
So in the discussion in either the AG's opinion or with Idaho's, is there a specified time frame for when they have to restore that amount of money, getting back to what we try to do with the Meyer rule, you know, once you take those realized capital gains for future earnings and pay that debt off. But was there any discussion as a time frame as to when that would have to be restored back to the corpus?
Mr. Chairman, in my reading of these, particularly in Wyoming law, no, there is not. Idaho does. Actually, Idaho references losses in their constitution and recognizes that they may happen. It in fact, in that provisions I was talking about, it talks about the benchmark not including deposits that were made for the purpose of recouping losses, clearly indicating that they acknowledge that there are losses and that they need to be recouped. I'm sorry though, but I don't know the answer of the exact timing of recouping those losses, but clearly they are expected to be done.
Because, Mr. Chairman, I guess if you do that, you could just carry those on the books. If there's not a reasonable time or mechanism to restore those, you just say, well, you know, we recognize the loss. I think there's a loophole there that you could just carry those on the books in perpetuity if you lost part of the corpus associated with your investment portfolio. If it doesn't specify, at least what we recognize, you're going to replace those with future capital gains.
Mr. Chairman, Senator Hicks, I don't have the exact answer to your question. You know, what Idaho says for their losses, I mean, they very clearly say how losses must be made up depending on the particular permanent fund. And I don't have the statute in front of me. I think those statutes are silent in terms of the timing. Now, that said, you know, I would note, Mr. Chairman, that you know, because Idaho is setting a gain benchmark value of their permanent fund each year, you know, that I think you'd have to read those in tandem to suggest that.
Within that.
Yeah.
Mr. Chairman, can I make one? I need to correct myself quite importantly, and that is that I get wrapped up in your question, but the fact is that the statute we passed last year does recognize that those netting of losses has to be done at the end of each year. So I mean, I guess there is an answer partially, at least to your question in that statute.
Go ahead.
So Ian, what if you don't have the means to make up the loss? You go to jail, what do you do?
Go to the back of the bus.
Yeah, go to the back of the bus?
Yeah, do not pass go.
Throw the treasurer in jail.
Mr. Chairman, I believe there's an accounting answer to that question. I don't know what it is. I don't know if Polly knows the answer. I've discussed this in the past, I believe, with Don Richards, but I believe there is a mechanism for accounting for those losses, carrying them forward. They don't just disappear at the end of the year.
Mr. Chairman.
Mr. Chairman, and I thought that's what we had done at other times. It wasn't that if you don't have the means, there's a mechanism there to carry them until that is resolved.
Sure.
Right.
Mr. Chairman, I'm sure that most people behind me could explain that, but there is a mechanism. I'm not entirely familiar with what it is.
Mr. Chairman, and the way the treasurer's office always done it in the past was they carried it, and usually it was the goal to have those realized ASAP, but I don't remember them ever going past 3 years was the most ever went. But that was how, you know, previous treasurers kind of usually did that. And we've had such V recoveries in the last while, it hasn't been much of an issue. Mr. Chairman, if I can, going back, and I just wanted to go back, I mean, when you go back to the Attorney General's opinion back in 2010, and you know, looking at this on page 14 in that footnote 40, and this is the Attorney General from Attorney General Salzberg, and he says that the state treasurer can sell agricultural fund investments at a loss if the sales are consistent with the prudent investor standard, and provided that the state is obligated to repay the losses should the fund's balance become negative when measured against the initial balance of the capital raised by the fund's lands. And so if I understand what you're saying, I don't know if you said this directly, but are we interpreting that, or are you interpreting that, you know, if they sold the land for $100,000 in 1968, that the value of the corpus is then fixed, at least as respect, if that's fixed as the cost basis of that sale at the time it was converted from land to a different asset?
Mr. Chairman, that is how I'm interpreting that language. Now, I don't mean it's just an AG opinion, but it's an AG opinion. We can disagree with that if we want, but I think that's how I took that language, to say that it's stuck in time at whatever we received at the time we sold it.
Okay, so Mr. Chairman, so then every year we'll take the we'll take the PMTF, because it's also got it in the violet provision as well. And so every year we've got the constitutional 1% of severance taxes that come in and provide new source of liquidity. And I'm assuming we consider the deposit at the value of the money that was contributed at that point in time. Does that then also then become the corpus for, is that how we value the corpus for funds that do have an increase in a regular and anticipated increase in corpus?
Mr. Chairman, I guess my initial duty is to tell you that the constitutional laws of the state don't make that entirely clear. But, because that's, I think, my point here is that how we treat losses, our duty to compensate, and the value of our corpuses themselves are not clearly set out in our law. Don't know that's a problem, but they're not there. Having said that, yes, my interpretation would be those new deposits to those corpuses, like in the Permanent Wyoming Mineral Trust Fund, would constitute new corpus and increase the value of the corpus going forward.
Mr. Chairman, so just continuing on that thought. So, and I think General Salzberg would agree with you too, based on the opinion he gave. So we've dealt with the cash contributions that we have. So then when we have a tip, so now let's go, and we've got several of these that, once we get to a certain amount in the reserve account, those tip over, and then those are added to corpus of the trust, right? Mm-hmm. And so then is it the cost basis of whatever the value of that tip is? Because I guess those are, they don't tip and they're not deposited until they've been realized. So we know the value of the corpus of the tip at the time of the tip. Is that correct?
Mr. Chairman, I think so. And particularly with regard to the Permanent Wyoming Mineral Trust Fund, we amended that language to include the words "from whatever source" to make inviolate. And I think that's particularly important to that fund, because I think it would include tips from the spending policies.
So, Mr. Chairman, and then continuing the same example, so that tips over, it's reinvested, there's a tip there. And those tips may be in cash or they may be in kind. It's just a transfer of value. And this is actually serious. I'm not making a joke here, but you've got a tip that's going to be, so the corpus is pegged, but if the cost basis of those securities dips down, then the corpus is actually diminished, and ultimately, if they're subsequently sold, that's a realized loss that has to be made up. Is that correct?
Mr. Chairman, I think there's two things. Brian just pointed out that in the language of the Constitution, it says all money is deposited from any source. I haven't done any research to indicate what the word monies means, whether that would mean unrealized or realized capital gains from in-kind transfers or from these transfers you're discussing into the funds. I don't know the answer to that. Brian, did you have? Okay.
I have one more question in this line. So the question is, and what this is all getting down to is, we kind of equate cost basis with corpus, but they're not exactly the same thing. That's what I'm getting. That's what I thought, and I think that's what I'm getting from this discussion. Is that a correct observation or incorrect?
Well, Mr. Chairman, I just do not at all know the answer to that question. And I think it's an important one, because it's something that Brian's going to talk about when we talk about, our disposition of income, interest, or earnings. And that is what constitutes interest, income, and earnings. Does it include unrealized capital gains? Do we want it to include unrealized capital gains to free them up? But I think that's a great question. And that's the fundamental issue here, is what is the value of corpus? And the Wyoming law currently doesn't, I think, completely define what it means and whether it should include those kind of gains.
So one last current question. So Mr. Chairman, one more. So as you get, I mean, ultimately it comes, it's a really important question. And I guess the question is do we track corpus? I'm under the impression that we do track, at least we have a calculation of corpus. Isn't that correct?
Mr. Chairman, we do have a calculation of corpus. I would have to turn to Polly to discuss what constitutes that corpus, because I don't know how it is current, the specifics of how it's currently tracked, but certainly it's tracked.
I think Polly was going to respond.
Oh, thank you, Mr. Chairman. Just to respond to Ian's question, I may not have the full answer for you, but I can tell you that in terms of the spending policy, just has been discussed, we use the value, the value that is at the beginning of the fiscal year, and we take it from the treasurer's portfolio statement.
Question. All on the trail, I just don't know where it's leading. Where we headed?
Well, I think this is one of the really important issues. I think this is one of the really important issues in 121 is that whether it's through constitutional amendment or by statute, whatever, I think we've got to define these. I mean, it's a gray area right now. And it's one of the issues and one of the purposes of 121 is, among other things, is to find this, because ultimately it gets, you know, if we're headed down the road of trying to get to to truly have the focus of the funds be the maximized investment for a risk-adjusted rate of return, then this is a really important question, because ultimately, if you turn this loose and we look at how we do this, you know, we just always have to keep in mind what that corpus is. And because one of the things we're talking about doing is if you move away from that and you were truly going to turn the investments loose, you simply would take your spending policy, and as long as there's sufficient unrealized returns between the two, so you've got it, so you're not ever invading corpus, you just turn your spending policies loose, and that just happen, and you don't worry about these guys going and invest their thing. And just like they said, they don't care. They don't care whether it's income, they don't care whether it's capital gain, they just go and do the best job they can of investment. And it's on the back end where we deal with the investment policy. And so, and
Stuff like haircuts, trying to keep up. So haircuts, we move to a different type of investment. It's a strategy to make the total return concept. These become important components.
right, because you would always get your spending policy, whatever that is, provided it never invades corpus. And so you obviously, if that's your limit, you can't invade corpus. You have to have a really clear definition of what corpus is. For in the event you get close, I mean, we've never been close to the line, but in the event you would get close to the line because of a significant market downturn that continued on for a while, it would become a very, very important question.
Okay, let's one more question and then we'll take a break.
I'll almost forgive. So
Well, before we take a break, how much more do we have on this particular subject?
That I'm actually done with that specific subject on what inviolate means. Brian has some other about the same length of discussion.
then, Mr. Chairman, the conversation that we had, I think, previous at our last meeting then is to obtain our spending policy, to get our spending policy. They sometimes have to sell, or we have to get those gains on our investment to get the cash flow to satisfy our general fund spending policy. Whereas if we could invade that corpus for a period of time and then recapture that and not sell those investments or not get those capital gains when it may not be the right time to sell.
Well, Mr. Chairman, and that's not quite right, because again, you're not going to invade corpus. You have to have a law. It doesn't matter as long as you stay above the corpus. The corpus is always going to be the floor. You can never descend below corpus. And so in extreme scenario, you might be in a situation where you might not get any money out of it. And you might, But, we're not gonna do with all of it. I mean, ultimately, that's what you're trying to do is you figure out how do you completely divorce any perverse incentive that investment people have? They just go do their job. And then it's up to us to realize how we harvest and put those to the best use.
Mr. Chairman. I think, and I hope I don't misstate what the potential policy is, but the issue there is, so not necessarily to invade the corpus, but my limited understanding of something like an endowment model would be that you would free up some of the unrealized gain, for example. This comes to the definition of income and earnings and whether you only can use those for distributions. If you can only use income, then you have to have the income. But what if we defined it differently or got rid of those definitions that would allow us to make distribution from something other than just income or just interest? So I think that's the issue about an endowment model that would allow some more freedom, but that also might diminish a fund.
Yeah.
Okay, we'll take a 10-minute break. We'll come back at 11. So Mike, I have a question. It's a bit noisy in here. The windows are open and also the folks next door.
I like the backup alarms. My favorite.
Yeah, and the backup needs, do we want to move to a different room? Or shut the windows?
They're done. They're done now.
Okay, well, we'll stay here unless we have something else. But I think we ought to close the windows.
They're not bulletproof anyway.
And the active admission, as I've already kind of outlined, the active admission, the Wyoming Constitution, and our statutes use these three terms in different places to refer to the investment proceeds or gains or earnings from the various permanent funds. And I think the big question here is, the Wyoming Supreme Court, if it were to, review a case involving these terms, they're going to assume that, when you use language in one part of statute or the Constitution and different language in another part, that there's different meanings were intended for each of those terms. This is also going to be true, I think, for the active admission. The use of the word interest versus the use of the word income in reference to the funds for the university purposes. There are various factors that can be considered in these three terms, and issues that come up with how these terms are used or may be interpreted. And I think the first would be the nature of the investment proceeds as interest, income, or earnings, the characteristics of those proceeds. The second would be whether realized capital gains are income, interest, or earnings. And then next, and I think this is already, Mr. Fleming already touched on this, the question of whether unrealized gains are income, interest, or earnings. And to that end, I would note, and we discussed this at the last meeting, the Attorney General's informal opinion concluding that unrealized gains are not income or earnings for purposes of investments, based on the concern that those unrealized gains would risk consuming the corpus if the state didn't have the liquid funds it's proposing to spend, and if the value of those unrealized assets could decrease by the time the state realizes those investments. I think this question is critical to the question of what investment model, what is the path forward. It likely requires careful consideration, particularly in terms of whether clear or express language is needed to define these terms. With that, I would note, Mr. Chairman and committee members, that the legislature has in the past, from 1986 to 2008, defined what income from investment, what from state investments is. So they took a constitutional term and defined it in statute. And that definition was interest increased by discount earned and gain realized on sale and reduced by premium and loss on sale. So that at least contemplates this idea that the legislature could define those terms. But in doing so, I think care has to be given that any legislative definition of a constitutional term has to bear some sort of reasonable and recognizable similarity to the generally accepted definitions that the drafters had in mind when they included those terms in the Constitution. That case law is from another state. It's not from Wyoming. I found no Wyoming case that really dealt with this question of a legislative definition in terms of a constitutional term, particularly in this context. But it's likely a principle that the Wyoming Supreme Court would find persuasive.
Well, part of the issue, though, they'll go back to the definition of interest in 1890. And as discussed earlier, the definite interest had a different meaning back then, and how we invest our money, securities, all those things that to a large degree didn't exist. And so you have to be able to extrapolate current conditions that did not exist then, and parse it out and place it where it fits in the closest, what would be over encompassing versus under encompassing of that particular definition back in 1890.
Yeah, Mr. Chairman, I think that ultimately, is a question the committee is going to have to decide in terms of, number one, where it wants to define those terms, or number two, whether certain, I think more directly, whether constitutional language needs to be changed, to use, say, the broader term of earnings versus interest or income. Similar to that, the ancillary, particularly for the permanent land fund, the common school account, You have the act of admission that also uses the term, a document drafted, by Congress in 1890 that uses the term interest, and whether a court is going to hew to the definition, in a dictionary at the turn of that century to interpret, what Congress meant by the use of that term interest. And I think there's also the issue of, Congress had to have meant something particular with that term, given that it used income elsewhere in the act of admission, it may evince some sort of intent that Congress meant something different for the university funds compared to the other permanent land funds. Mr. Chairman, with that, moving on, just some other issues to consider in light of these three terms. I think the appropriateness of applying investment proceeds for other purposes. And I think this gets to the question of inflation proofing. And more directly, there is constitutional language, for the higher education section that clearly contemplates the use of the earnings for those purposes. The other funds, with the exception maybe of the permanent land fund in Article 18, Section 6, lacks that language. And that may be another consideration for the committee, whether language like that should be or needs to be inserted in the Constitution for that purpose. And then finally, whether the origin of investment proceeds can impact the application and distribution of those proceeds, and whether there's some requirement that they be deposited to the corpus of a permanent fund. And here the example would be, clearly the act of admission contemplates the sale of those granted lands. Those proceeds must be deposited into the corpus. And I think all, to kind of bring this together, all of these issues, are probably going to be implicated if the select committee considers any changes to this investment model. And ultimately, the question would be whether there's any need to define or modify or otherwise, change the terms that are used in the Constitution and the statute in accordance with changes that that the state may make to its investment model or investment processes. With that, Mr. Chairman, before I move on, I'm happy to answer questions.
Questions? All right, please proceed.
Okay, thank you, Mr. Chairman. The last issue I'll cover is one that was directly included in the language in Senate File 121, and that's this issue of the applicability of uniform laws to the state's management and maintenance of these permanent funds. Wyoming has adopted various uniform laws, and I'll just run through them briefly. The Uniform Prudent Investor Act, which requires a trustee who manages assets to conform to the prudent investor rule, owing a duty to the beneficiaries of the trust and acting impartially in investing and managing trust assets if there's multiple beneficiaries. The Uniform Principal and Income Act, which requires fiduciaries to comply with various general principles of trust administration, administering the trust according to the plain terms of the trust, or in accordance with the Uniform Act and the exercise of certain discretionary powers in the administration of a trust. The Uniform Trust Code, which is simply a codification of the common law of trusts, and provides various provisions for the creation, modification, and termination of trusts, as well as the duties and powers that the trustees have in managing and operating those trusts. The Uniform Prudent Management of Institutional Funds Act, which requires the management of certain funds in accordance with various modern investment and expenditure practices. And then finally, the Unitrust Act, which provides for the creation and conversion of unitrusts and the administration and distributions from those trusts in terms of current and future beneficiaries. Now, the question of their applicability to Wyoming state funds. There's only one of these uniform acts, and that's the Uniform Prudent Investor Act, that has language that expressly makes that act applicable to the public funds of the state, and that's 4-10-911. The other uniform acts either lack that express applicability language or include applicability language that doesn't expressly reference the state and its funds. And I think, the question there is, the court in interpreting, the applicability of Uniform Act is going to see that the legislature has made one particular act applicable. It has not included that language in the others, which may suggest an intent that those other uniform acts do not apply. There's one exception that I'll briefly mention, and that's the Uniform Prudent Management of Institutional Funds Act. That act does not have a specific applicability section, but in its definitions, there's a definition of institution and charitable purpose, which may include or encompass the state and its fund and the management of its funds. So institution is defined to include a government or a governmental subdivision to the extent that it holds funds exclusively for a charitable purpose. Then the definition of charitable purpose is defined to mean, among other things, the promotion of a governmental purpose or any other purpose, the achievement of which is beneficial to the community. And so it could be potentially argued that under those broad definitions, that act would apply to the state's managements of its funds. And I think really here, the question for the committee to decide is, number one, should or do these acts need to apply? And number two, particularly for the other uniform acts for which there is no clear language, whether clear language is needed that says that act applies or does not apply. That although would be matters of statute, that does not include the question of, say the establishment of a trust through other language that may be in, say, the Act of Admission or the Constitution.
Do we know if other states have done that?
Mr. Chairman, I do not. But that's something we can look into. And then finally, Mr. Chairman, the final point that I'll just briefly discuss is.
Ryan, before I lose track of it, I know that there was one or two AG opinions and also opinions out of the State Land Office on school trust lands that are, because it's supposed to be used for the maximum benefit for the schools, and yet you got grazing leases that are, you're paying $15 per AUM. And clearly, that's not the maximum benefit, but I've read the opinions before that say it's still a reasonable use, and it fits within that definition. Because you look at aesthetic qualities, you look at other components to it, not just pure monetary, things like that. So I know there's an AG opinion or two out there like that. It might be worthwhile to add into our packet here.
Sure thing, Mr. Chairman.
Sorry to interrupt you.
No worries. The final point I'll discuss is the applicability of generally accepted accounting principles. And Wyoming statute provides that it's the legislature's intent to establish uniform requirements for state government accounting and financial reporting in accordance with GAAP. And statute further provides that you cannot deviate from those standards unless otherwise authorized by law. With that, I would just note that mandate for the use of those principles is statutory, it's not constitutional, and it's also not federal. The other point that I would make in regard to those principles is that it appears to focus on accounting, and it's unclear whether, those principles would apply to the substantive provisions that concern the permanent funds and the requirements and limitations, particularly given that those provisions are based either in Constitution or in federal law. And with that, Mr. Chairman, that concludes my part, and happy to answer any questions.
Well, I think we know the answer to that. And that is, if we change the law that is different than GAAP, then the law prevails. So,
Mr. Chairman, that's right. Yeah.
Questions for Ryan? Go ahead, Chair.
Thank you, Mr. Chairman. I guess just to comment about that, maybe the gap is maybe the default position unless otherwise authorized, so that we have some kind of basic standard, which would be the language of generally accepted accounting principles. Just a comment.
Mr. Chairman, Representative Obermuller, I think certainly as it pertains to, the accounting maybe of the state funds, that may well be true. I just want to make sure I draw a distinction between that and the substantive requirements of, say, the distribution of income from a particular fund that has its basis in either the Act of Admission or the Constitution. So, Mr. Chairman, that's really the only point I was trying to make with that.
Follow up, Mr. Chairman.
Please.
Thank you. So in that regard, if you're looking at some kind of an endowment model or whatever, and you start out with the definition provided by GAAP, that would immediately incorporate unrealized gains within that basic definition. So if you didn't want that, that would force you to specifically exclude unrealized capital gains. So it would set a foundation upon which you built your exclusions or inclusions, right? Thank you, Mr. Chairman.
Okay, any further questions or comments? Seeing none, where does that take us next? Where did my schedule go? HB 244.
One more comment with regard to the 121 study. And then I'll make it quick because I realize we need to move on. You'll notice in the memo that I think it brings up a lot of great issues, but it doesn't provide a lot of specific advice on what the committee should do. And I just wanted to make a plea that I think the 121 study is broad and we have to do a lot of work to cover its mandates. But we as LSO and Brian and I would benefit from whatever direction the committee can give us about the direction it's thinking about with specific investment policies, because that allows us, I mean, it's hard to say what constitutional changes do you want or what statutory changes you want when we have no idea what the end goal is. We can talk about the law and what's out there, but when you want, and I think this committee eventually, whether it's this year or next, will want to have some concrete ideas or a bill draft on actual changes. And I just need to make a plea that in order to do that, we'll have to have some more direction from the committee.
I think there's a good opportunity that we'll do that.
Oh, I thought they were going to tell us what we needed to do.
Okay, 244. Treasurer Meyer. Do we know if we're going to have any IFC members participate in this? He's on. Okay, well, you want to call him or text him again? Okay. Let us know when he's up.
Representative Nicholas, he's in the room and he does have his audio and video on at this point.
Right. Well, Tom, if you're, can you hear us yet? Oh, okay. Well, let's proceed then. Treasurer Meyer.
Yeah, Mr. Chairman, we're moving forward with RBK. They're doing their interviews, and I think Jim knows a lot more about where they're at on that than I do. But we're following essentially the rules that were set forth in 244 and trying to hopefully comply with the goals of that piece of legislation.
So what my recollection is, Treasurer Meyer, that they were going to have a preliminary or report by sometime in the kind of an outline by the mid to late September prior to the next IFC meeting so that we could kind of review it, garnish it, and then our next IFC member is first part of October, is that right? Or the 27th? 27th of September.
I think Jim will tell us when they're going to get close to having some kind of a draft that the
Right.
IFC can look at. And it's necessarily not RVK's job to tell the IFC what the outcome is. It's for them to give us the information so we can.
Right, they're
formulate the
assimilating the
outcome.
data essentially.
Yep.
And various options. So with that, I think we're ready to go to Jim. So Jim, please introduce yourself and tell us where we're at.
Well, thank you, Mr. Chair, members of the committee. Can I be heard clearly?
We can hear you fine.
That's great. I have 5 key points to offer you today with respect to an update regarding the ongoing RVK investment program review team project that the IFC has hired us for. Let me get to the point very quickly, or I should say get to the 5 points very quickly. But before I do that, I do want to say that our project proposal to the IFC and the scope of work was explicitly patterned on HB 244. And we adhered very, very close to it in the support that we promised that we would give to the IFC and the task that has been assigned them by the legislature. So with respect to those 5 points, Mr. Chair and members of the committee, point number 1 is we remain on schedule to deliver our report to the IFC. And we're talking about at a minimum, a draft final report, no later than October 1st. That said, I have to say that it has taken and is taking a substantial amount of team effort to meet this tight deadline for such a challenging assignment. But we expected the project to be quite expansive, and we created an unusually large team to tackle it. It's proved to be every bit as expansive and time-consuming as we expected, but we are on schedule. That's point number 1. Point number 2 is that as we have done our work, the importance of our team meeting that October 1st deadline, and I think you referenced this, Mr. Chair, is becoming more obviously critical to us as our work progresses. And that is because it's quite clear to us, as the treasurer said, that the IFC is the body that is charged under 244 to deliver a report and potentially recommendations to the legislature. And it faces an equally intense and focused period of work during the month of October if they are to deliver recommendations on the Wyoming Sovereign Wealth Fund investment program structure and operating principles to the legislature by November 1st, which is, we understand, the aspirational goal. So I guess what we would say based on the work that we've done so far is that to our client, the IFC, we suggest that if our team's current experience is any guide, prepare for the possibility of quite a few collaborative hours of deep discussion and engagement during the month of October. That's point number 2. Point number 3, Mr. Chair and members of the committee, is that we have, as the treasurer indicated, been quite busy gathering information. Just to give you a sense of that, the RVK project team has thus far interviewed a very lengthy list of individuals. We think it's virtually comprehensive within Wyoming who are directly involved in or have special knowledge about the context of the existing investment program that affects the permanent fund in Wyoming, as well as, by the way, the several minor funds that the IFC is an advisory body on. We've interviewed very senior individuals from many of the comparator institutions across the country and overseas, by the way, that we collaboratively with the IFC selected for more intense study to see if they had lessons to offer. And as I said, some of these, most of these are within the US, almost all of them, I think all of them are at the state level, and chosen specifically because there were aspects of them that related to the Wyoming current structure and the mandate and the funds that both the SLIB and the IFC are responsible for. So we've researched the structural elements of these comparator institutions using a common template and approach so that we could get as close as possible to apples comparisons on specific elements of their structure to see if there are insights that can be offered to the IFC in their October task. And we've also, at the same time, had a part of our team that has been reviewing an expansive set of documents, including in particular governing statutes for these institutions and of course for Wyoming's as well. So point number 3 is that we've been busy. We are well over halfway through that effort, but we still have more to do there and are proceeding apace. Point number 4, Mr. Chair and members of the committee, are that in early discussions on this project with the IFC, which were quite robust, much of the focus revolved around learning from these comparator institutions. And indeed, I can say on behalf of our team that our report will be chock-a-block full of detail on these institutions, their structures, the objectives that underlie the structures that these entities have chosen, and how they actually operate. But I will say that as our work has progressed, we have come to appreciate that these structures actually reflect objectives that in turn reflect trade-offs that lie underneath them. And I think this is, whenever we do a project, we learn as well. And I'll give you an example. One example is the inherent trade-off between degree of oversight by politically constituted authorities, both as individuals and offices and so on, versus investment and operational independence. No two institutions lie on that trade-off spectrum precisely in the same place. Another is the trade-off between degree of accountability and the delegation to expertise. Again, none of these comparator institutions lie in precisely the same place on the trade-off between those. So strongly do we feel about the importance of these fundamental trade-offs as the essential drivers of any structure that Wyoming might consider, including retention of the one that you have today. All of that is well above our pay grade, but that what you will see is that that our report is likely to have the entire first section of the report focus on these trade-offs as our best thinking about the way to infuse knowledge that we gleaned from our research, but also help frame and create paradigms to help the IFC in its task to deliver the report required by HB 244. We feel very strongly about this, and we think that when you see the final report, you'll see why we do. So that's point number 4, that it's not just structure, it's also the objectives and the trade-offs that have created those structures that we think are critical to understand if Wyoming is to consider any changes. Point number 5, and it's the last point that I'll make, and thank you for the time that you've given me. In the spirit of our mission, which is to, as the treasurer said, to support the IFC in the development of its thinking and potential recommendations to the legislature, but not decide them for them, you can expect our report not to have an explicit recommendation of an RVK recommended structure. But you'll see quite a bit of discussion in it as to what structural elements align with decisions that place any new structure that Wyoming might consider along the spectrum created by the trade-offs that I discussed in point number 4. I'm going to stop at this point, Mr. Chair, and simply note that the project team at RVK is currently quite in the thick of it, to say the least. Our work is very much in progress. I don't have any formal conclusions to give you. It would be unfair to the team and not reflective of the fact that we still have thinking and research to do so. So at this time, I'm going to stop with the points that I've made above, and I hope that you find it a useful status report in the sense of milestones and progress. And I also wanted to say in this venue that we as a firm thank you for the trust that the IFC and the state of Wyoming has shown us in assigning us this obviously important supportive work. So, Mr. Chair, I'll stop there and I can stand for questions if you like.
Questions? Well, thank you, Jim, for the update. I don't think we've got any questions at this point. We're just kind of getting updated, but we're awful excited about the draft plan and we're in our coming October. So
Thank you.
you bet.
Mr. Chairman?
Please.
And we appreciate your time and effort, and I'll just give you the advice that when I was a brand new attorney that my mentor and overseeing attorney told me when I first went off to court. I came in and asked him, do you have any suggestions for me as I go off to do this? And he said, yeah, don't screw it up. So anyway, there you go.
Well taken, well taken.
Okay, well, thank you very much. Treasurer Meyer, anything else?
I just say that as I go to different conferences and talk to different folks about their offices and their organizations, and the saying is, if you've seen one treasurer's office, you've seen one treasurer's office. And I think we'll find out that if you've seen one organization for investing, you've seen one organization for investing, because every one of them is a little bit different, and the basis for those differences, I think, are in the discussion that Jim mentioned, and so there are going to be trade-offs. I'm hoping that as we look at this, that we stay with the main goals of 244, which is to achieve the best long-term returns, and look at I guess a process that will hope to do that. I look at this as an evolutionary process, and hopefully getting incremental returns and understanding what our risk appetite is. And again, I'll thank you guys for allowing us to have the process of our reference portfolio. That I think is going to be the single largest thing, as well as getting a functional 121 aspect as far as moving the risks in the right direction that we can do within the immediate future. Thank you.
You're welcome. It's a fun, exciting time. So fun stuff. Okay, it's 11:43.
Mr. Chair.
Hey, Tom, there you are.
Hi, so sorry about that.
All right.
Yeah, I really don't have much to say, and want to thank the committee members for all their work. One of the things I did want to mention, just as the vice chair, that I've talked with a few of the IFC members, and we know the sprint's about to start here October 1st. While we want to see a draft of this report tomorrow, we understand that we're hopefully going to get this thing before the 27th. But I'm pushing Jim and RVK to get it as soon as possible so that we can kind of get going. But I think the good news here is that the IFC members are fairly fluid with the issues and the different plans, the different structures, thanks in a large part with the Treasurer's Office in terms of the conferences we've had and the interactions that we've had. But we need to map out, I think, October 1st with the Treasurer's Office on kind of our workload and meeting schedule to make sure that we're well prepared for November 1st. But I think that the IFC is extremely excited to work on this. I say that maybe joking a little bit, but I think it's a great opportunity for the state of Wyoming, and I think that we're all excited to see the report and work on it. So thank you.
Thank you, Tom. Good seeing you. And I've mentioned this to the IFC in the past, and that is that we always want to be on time and on budget, but understanding that it's a fairly common event. If you're a week late, if you're 2 weeks late, in order to get a better product, we want the best product. And we know that we're imposing on your individual lifestyles and other obligations. And so we just want you to do what you have to do, but don't run too fast around the track, just in order to get it done fast. So.
Yeah, it's all that high salary they get paid.
Yeah.
Oh, wait a second.
Absolutely. I think it's going to be a bit of an iterative process. So, but I think we all know that. Anyway, but I think the group's looking forward to working with Treasurer's Office and really trying to come up with a great product.
Okay, any questions for Tom? Seeing none, and I haven't really been asking for public comment, but it doesn't really fit this committee too well.
Is there anybody in the waiting room?
I don't believe so. I don't think there's anyone here to have public comments. So isn't anybody here to have public comment for anything we did this morning? Seeing none. Okay. Now we've got 15 minutes. Do we want to jump into the next topic or do we want to come back early? Do we have a preference? Because Patrick, you're up on the performance update. So, all right. How about if we break now and let's make it a quicker break. Let's come back at 12:30 so we can get out of here quicker. All right, so we'll stand in recess till 12:30.
Oh, Mr. Chairman?
Yes.
He's eating into my 45 minutes.
Well, I know, but I'm